So what is Boeing saying? Boeing is saying, I'm losing market cap because of Spirit's issues, so best to in-house it and control it. Now, I think it's up for debate. What's the best solution for Boeing? Do they put 2 board seats in and sort of manage it from afar? Do they take it over completely? Boeing has had its own supply chain issues, not only due to Spirit, but mostly due to Spirit.
So not to be too basic about this, but do we really know what went wrong to begin with? Was it Spirit Aerosystems or was this a Boeing problem? Do we have a sense?
What went wrong where? There's been a lot of issues. So there's been a lot of issues. You know, when we look at the 787, that was a Boeing and Spirit issue. We didn't have 787 deliveries for essentially 2 years. And then Spirit's been the cause of the recent hiccups. Now, it's the cause of the 737 hiccups, and it's such a big deal because the MAX is about 60% of Boeing's free cash flow. So when you're stuck at a rate of 20 a month and you're supposed to be at 40 a month, what's the cause of that issue? It seems like the engine manufacturers and the metal folks are out of it. They've sort of had employees tick up, and they're increasing capacity, so they're off the hook for now. So it all comes back to Spirit. And what's the best way to fix it? Now, Pat Shanahan, the Boeing veteran, just has been there since October. So it's only been 4 months.
So the regulators, they're coming in, they're saying, we don't really understand what your plan is. They say that there seem to be some really problematic cultural issues, a lack of certain clear signals about how to have safety controls. What are they thinking right now, given the fact that this is it? This is the only game in town for the United States when it comes to plane making.
Yeah, so I think the regulators almost take a regulatory view, and that's it. They're not going to manage who's managing these companies, who's investing in them. They just want to, reading, what they put out, they just want to sort of check the box and say there's safety protocols to the extent they can. They're not. Boeing is not a nationalized company. They can't go in and sit there forever as they've been scrutinizing the MAX line. So I think the regulators have a very hard line to draw, and so does Boeing management. It's like how involved do you get in the supply chain? What's okay? And so perhaps that's resulting in this latest move, is that maybe we need to be completely involved and completely take it in.
Given they are buying back Spirit, do you foresee any hurdles when it comes to the regulation?
I think maybe one of the hurdles is Airbus. Spirit manufactures about 20% of its output to Airbus. It's diversified over the past decade as it's needed other sources of cash, but that business is losing money. So perhaps, obviously, Airbus is not going to let Boeing take that in-house, so that would be divested. At what price, given it's losing about $200 million of free cash flow annually? But, I don't know about the regulatory hurdle in terms of what it means for in-housing. I mean, it means Boeing has more control over the supply chain, and are the regulatory bodies okay with that?
If this was any other industry at all, with only 2 major competitors, and the one was going through what Boeing's going through right now, you'd think the other one was just sitting there rubbing its hands. How does Airbus take advantage of this situation for Boeing? How can they do that?
It really has taken advantage. So Airbus basically has 60% market share of the narrow-body market, where the MAX plays the A320. And it's particularly done well on the A321 because we don't have a MAX 10 certified. And the MAX 10 is 10% more capacity, and that's what airlines like United are very focused on, right? And if you look at the United 10K came out on Friday or Thursday, they're cutting their aircraft intake by 50% for this year, their contractual intake. And that's one of the largest carriers in the world, right? So that means there's a shortage, clearly. So Airbus has taken share 60%. But it really can't go beyond that because it can't deliver sooner than 2028 or 2029. On the wide-body market, Boeing's still doing really well. It has 60% share because the 787 is the dominant aircraft there over the A350.
Can you put prices up if you're Airbus? How easy is it to do that?
One would think. I mean, I think that's the play. Even in a global duopoly where both are successful, pricing should be up because airlines are telling you Ryanair cut their summer schedule by 20% and raised airfares by 10%. So airlines are telling you we need these planes. We'll probably pay a good price for them. So I think, assuming Boeing and Airbus are very healthy players, they should both be able to increase prices.
Really looking forward to catching up with Michael O'Leary at some point in the next few months. We've got a ton of questions for the Ryanair boss. I wanted to finish with this one just quickly. Whether that incident in the last 2 months, last 3 months, violated that deferred prosecution agreement with the government, and whether ultimately Boeing could face criminal liability. What are you telling clients about that at the moment, from the professionals, the experts you speak to? How close are we to that happening?
I can't opine on that, but I think that's just not, it's Boeing manufacturing aircraft. I don't know what where the criminal element comes into that. And, you know, we could regulate banks, we could regulate aircraft manufacturers. At what point do we go too far?
Sheila, it's good to see you. Ready to catch up. Sheila Coley there of Jefferies on the latest with Boeing. And Michael O'Leary, if you're watching, I know sometimes you are. We want to make that happen soon, don't we, Bramo?
Yeah, especially because they're going to buy some of those MAX 737 jets. I mean, this is basically my question. Are you going to have lower cost airlines saying, if you want to sell your discounted Boeing planes, we're your guys, and you know the other airlines are forced paying a premium for Boeing, for Airbus, rather.
I'm not sure how much of a marketing scheme that actually is, but okay. Looking forward to that. Coming from an airline near you, apparently. Equity futures right now on the S&P, negative by 0.2% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Santander is said to have cut about 320 U.S. jobs. The source says about 2.7% of employees in retail operations across U.S. branches were recently let go. Santander told Bloomberg it's updated its staffing model and is investing in digital capabilities. Shares in Macy's are higher pre-market after investors boosted a takeover bid. Arkhouse and Brigade increased their offer by 14%. It's now at $24 per share, up from $21. It's also a 33% premium to Macy's Friday close. They had earlier rejected a bid in January and instead unveiled a restructuring plan where they'd close a third of the Macy's locations while growing Bloomingdale's and Bluemercury. California and parts of the U.S. West Coast are set to face more dangerous wind gusts and deep snow to start the week. Already days of winter weather have blanketed the area with as much as 8 feet of snow. The deadly conditions forced road closures between California and Nevada. Meanwhile, Amtrak canceled trains across the region. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, the ECB preparing to cut.
I think June is going to be a massive month for markets. I think the Bank of England, the Fed, and the ECB are probably all going to cut rates, and then it's a question of how far they go.
That conversation is coming up next, live from New York City. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Next week, Bloomberg brings you the latest from China's annual National People's Congress, including China's budget plans, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg. Context changes everything.
Stocks negative, we're down by 0.15% on the S&P 500. In the bond market, yields higher by 3 basis points, 421 on a 10-year. Quick check of the euro against the dollar positive by 0.2%, 108.57. Under surveillance this morning, the ECB preparing to cut.
it's entirely possible that we're just adjusting here to a higher growth, slightly higher inflation environment. We've completely left the low interest rate world, and we're just having a little bit of a problem here, and central banks are having it too, just understanding what's the normal rate of growth for real GDP, where will inflation settle at, and what interest rate will you need just to balance the economy. I think June is going to be a massive month for markets. I think the Bank of England, the Fed, and the ECB are probably all going to cut rates, and then it's a question of how far they go.
Here's the latest. Investors betting on June for an ECB rate cut ahead of the bank's meeting on Thursday. It's the first of decisions before the BOJ, BOE and Fed in the coming weeks. Rubber Bank's Jane Foley saying this: we don't see the first really live ECB meeting before June, with risk that September may bring the first rate cut. There may be the risk of a technical move in the refinance rate to narrow the corridor this month. Jane, I'm pleased to say, joins us now. Before we get into that technicality, Jane, let's just talk about the risk of the ECB cut being pushed out even further, out to, say, September. What's behind that?
Well, quite simply because they do have an inflation target, and they've told us that they're really watching the labour market dynamics. And we know, parts of Europe, like there are in the US and the UK too, that there are still labour shortages. This, of course, is related to the ageing demographic. It's not something which can be cured really simply. But, we look at that service sector inflation. We can pick any of those economies. You could even throw Japan certainly into this equation too. You look at the service sector, we know that labour is the largest part for the bills of most service sector companies, and labour shortages suggest that the service sector inflation is therefore going to be sticky. That's what we've been told, and the ECB have got a very straightforward vanilla inflation target, and that's the risk therefore that they may delay beyond June until September.
John doesn't think that the ECB meeting should be held on Thursday. He thinks it should have been held in tandem with the Fed's meeting. And I am curious about that in terms of, are they kind of dependent on one another, or rather ECB kind of dependent on the Fed and the fact that it's getting pushed out further for the US, and so it gives the freedom to the ECB to push it out a little further as well?
Yeah, I think there is certain, justification for that. And we only need to look at the exchange rate to get that justification, because, whoever goes first or whoever goes more aggressively could see their exchange rate dropping. And given that we're still in an inflationary environment, inflation is generally higher than the target rates in most countries in the G10. Well, they don't necessarily want that. So it could be that if we do begin seeing a continued resilience of the US economy, this debate appearing that maybe the Fed could wait until after the US presidential election, because obviously the timing of that could thwart some of their the chances for them to go. So that could certainly impact other central banks because of the impact or the potential impact on the exchange rate.
With that in mind, how are you watching Fed Chair Jay Powell's testimony to the House and the Senate later this week, given that we've heard a slightly different tone from him than some of the other Fed members? But honestly, the economic data has jerked around markets more than some of the recent rhetoric.
Well, to be honest, I do think it is going to be the data over the next couple of months that's going to feed everybody's outlook, including, Chair Powell's. The data on Friday, of course, is going to be really, really important, as then, the next month's worth of CPI and PCE data, all of that, put together is going to form the opinion of whether or not they can go in June or not. Now, our view last year was that the first move for the Fed would be June. And when we sort of announced that, that appeared very, very hawkish compared with what the market was thinking. No longer the case. But if this data continues to be sticky, there is the possibility that they could certainly delay until later in the year. And that, I think, is something which the market is going to be looking for very, very closely.
Our Bloomberg survey shows that lowering interest rates too soon would be worse than reducing too late when it comes to the ECB in the survey of economists. Do you see the same, then, justification for the Fed?
Absolutely. No policymaker wants to be associated with a policy mistake. And I think right now, the risk is that they could make a mistake and they could cut too soon. Inflation could remain far stickier for longer, because we know that that's the risk already. And we've already talked about wage inflation being sticky. But, what if, we get a Trump president? What if he announces those tariffs that he's already been talking about? That could be inflationary for the US economy. That's going to be something, for next year. But certainly, if that were to happen and the Fed, has cut perhaps too much or too soon, well, they're still going to be the ones, in the spotlight having to explain those moves. So certainly, I think for most of the G10, they will probably like to hold on longer and then maybe cut a bit more aggressively than go quickly and then be perceived as having made a mistake.
Speaking of another G10 currency, can we talk about the Japanese yen? Jane, a glimmer of yen strength last week for the first time this year, a conversation about maybe some kind of imminent rate hike. We've got the Japanese government considering calling this whole regime deflationary. This is decades in the making, Jane. How close are we to an interest rate hike from the BOJ?
I think we are very close, but the caveat here is that when we do get that hike, assuming we get that hike, it's probably going to be very, very little, and we're not going to get progressive quarterly moves. Maybe we'll get one more small interest rate hike this year. Maybe we won't, and I think that's what the market's been adjusting to these last few weeks. But we did have a really interesting piece of data out overnight, and that was capital expenditure. It was huge compared with what the market was expecting. Now, of course, in Japan they've got the worst demographics compared with anywhere else, and companies are desperately trying to invest to try and replace labour because there isn't much availability of labour. That expenditure figure, capital expenditure figure, was huge, and that could mean that GDP for the fourth quarter is revised up, which would have meant that Japan didn't fall into technical recession at the end of last year after all. So, that's a positive. But certainly looking through the speeches from the Bank of Japan officials, they're telling us that they've made preparations for a move in interest rates. And I think if it's not March, I think April is the most likely date for that.
If we had a list of worries, just theoretically, if one of us had a list of potential tail risks that things could go wrong this year, last year it would have been that the Bank of Japan suddenly hikes rates pretty dramatically, that the ECB cuts rates much more aggressively than the Federal Reserve, that the Federal Reserve cuts rates more aggressively. There are all of these potential tail risks. Right now, what do you think is the biggest central bank-driven risk to markets?
Well, it's still that inflation just remains stickier. And I still think that from just an economic sense, it comes back to the labour market. The labour market just been really, really tight. Now, of course, we can throw in geopolitics to that too. The Red Sea, for instance, I think, we've already had the ECB make a reference to that. That could come through. The possibility of Trump tariffs, again, adding to inflation too. So it's still the risk to me that we've got to a completely different environment, and one in which inflation is just going to be a lot stickier than we were accustomed to in the post-global financial crisis years.
Jane, just quickly, favourite trade right now, Jane, for you and the team at Rabobank, what is it?
I think we should look at the Swiss franc. There is a chance come March that they could be a lot more hawkish than we think. So, keep an eye on the Swiss franc.
One for TK. Jane, thank you. Jane Foley of Rabobank loves the Swissy. Loves the Swissy, that and the Turkish lira. We miss that, don't we?
Well, we would have started the show.
Every morning it turns to me.
Exactly.
I know, every single day.
State of the Union, it's jobs report. Check out the Swissy.
Dollar Swiss. Right now, I want to check out Kit Juice of SocGen. Great note this morning. The dollar is reliant on a diet rich in US exceptionalism. Big week for economic data.
Especially given the fact that we get the JOLTS report on Tuesday, sort of the front runner, the ADP on Wednesday, and then we get the jobs number on Friday. How much do we get those concerns about an overheating economy that accelerate if we get a hot labor market? To me, that's got to be one of the biggest risks to markets right now.
Sneak peek of the survey at the moment. I'll go through the numbers for you. Median estimate in our survey. These numbers can change. More estimates will come through. 200,000 is the median estimate at the moment. The previous number last month, as you know, was just a monster 353,000. Our survey indicating unemployment will stay at 3.7%. Going to be laser focused again on wage growth.
Given the fact that this is really an inflation story, there are two schools of thought here. One, there are people saying, look, we're getting growth, but it's disinflationary growth. It's the perfect sort of, it was all just transitory. And then you have other people saying, when you get growth like this, it is unsustainable without some sort of inflation. And if you get that wage growth, that'll feed into the latter scenario rather than the former.
Are you struggling for things to put on your list of worries? Is that what that question was about?
I mean, kind of. I mean, it was sort of extreme moves by the Fed, the ECB, the Bank of Japan. They seem pretty, pretty happy just to let things go. There's this question of accelerating one way or another. Yeah, what do you have?
I've got a solution for you. Up next on the programme, Nuria Rabini of Rabini Macro Associates. Catch up with him. Torsten Slock of Apollo. Torsten with a big call, saying no rate cuts in 2024. Torsten joining us in just a moment, and we'll catch up with some of Bloomberg's best, Michael Shepard and Enda Curran. That and a whole lot more, live from New York City, the second hour of Bloomberg Surveillance, up next.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The longer rates stay elevated, of course, the more likely it is that we have some type of financial accident.
I think the risk is that the Fed goes less rather than more.
At the end of the day, we are seeing no urgency on the economic side to cut rates.
We still have an expectation of 4 rate cuts this year. We think that the Fed will start in June.
I'm at 1 to 2 cuts this year. I'm not at Torsten Slog 0 cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. Live this hour, Torsten Slok of Apollo on why he thinks you'll get no interest rate cuts in 2024. This week, a double dose of Chairman Powell. Bramo, he's got a big question. Can you cut interest rates when stocks are at all-time highs?
Can you cut interest rates when you have a fully employed America, to quote someone we both know? Can you cut rates if you have a feeling that this economy isn't slowing down and may even be heating up? And it is a huge question, not just for Chair Powell, but also for the State of the Union, and also for a lot of people in markets that are sending stocks to all-time highs.
AMH, I'm going to say this on repeat, I think, over the next couple of days. Monster week on Capitol Hill over the next few days.
It absolutely is. We're going to get Jay Powell in front of the House and as well as the Senate. You have Super Tuesday tomorrow. It's all but done, so not so Super Tuesday. day, but it's an important day to see. You can read some of the tea leaves and who's going out and voting in some of these states. But then for me, the biggest is going to be the State of the Union. In terms of Biden's performance, because poll after poll over the weekend showed he's even losing voters in terms of how they're feeling about him. The ones he gained in 2020, about they think he's just too old. So for me, it's less what he says, how he says it. Washington Post this morning saying, give him hell, Joe, but keep the State of the Union shorter.
Equity markets all-time highs. Unemployment sat at 4% for something like 24 months, maybe even more than 2 years based on the data we get on Friday. And somehow he can't connect with this electorate. Somehow this electorate thinks this economy is doing poorly.
This electorate has a lot of issues on its mind right now. And I will just say that you can't speak of the electorate as some sort of monolith, because you have people who still are grappling with prices that are much higher than they were a couple of years ago. We talk about the sort of collective or the buildup, the residual kinds of inflation. But there's social issues. There's a feeling of which political party you belong to. There's a feeling of some of the, which kind of media you're hooked into. I mean, these are things that are real.
You're hooked into Bloomberg right now. We can talk about all-time highs without the politics. And we'll talk about strategists on Wall Street upgrading their targets. In the last week, UBS, Goldman, Piper, Barclays, Bank of America, Savita Subramaniam joining the team. A handful of upgrades. So we've got Goldman Yardeni at 5,400, Savita now 5K at to 5,400.
So let's just frame this out. This sounds bullish when you talk about the upgrade. It's only a 5% gain from where we are. She's talking about the likelihood of a potential pullback before you get that said 5% gain. So it's sort of basically coming to the market and saying it doesn't look completely unsustainable, because guess what? Big tech is actually delivering the goods, delivering the earnings. We can't bet against them and just call it a bubble and go home and hide.
It did again last week, up and away. Equity futures, a little lower. We're down by 0.15% on the S&P 500. In the bond market, yields higher by 2 basis points, 420.33. Big hour coming up. Nuria Rabini of Rabini Macro Associates as the S&P 500 hits another all-time high. Bloomberg's Ender Curran looking ahead to the China National People's Congress, and Apollo's Torsten Slot later this hour on his call for no Fed rate cuts this year. We begin with our top story. Wall Street strategists racing to upgrade targets as the S&P 500 posts its 15th record high this year. Nuria Rabini of Rabini Macro Associates writing this: equity valuations are high and some correction may occur, especially if a growth slowdown weakens earnings growth. A soft landing is best for equity markets as a growth slowdown with rate cuts and lower bond yields lifts equity valuations. Nouriel is with us through much of the next hour around the table. Nouriel, good morning to you, sir.
Good morning, John.
It's good to see you. I was reading through some of your work, and I have to say, it didn't seem like you were worried about too much in this economy, in this market. Is that right?
Well, I'm less worried than the past. I think a year ago, people were worried about a hard landing. Then they started talking about the softish landing with a short and shallow recession. Now people talk about a soft landing, but there is serious possibility of what people refer to as a no landing, that growth remains above potential, and inflation remains sticky. And actually, of all scenarios, the one that is more risky for the market compared to a soft landing is a no landing, because markets were pricing in 6 rates cut by the Fed earlier this year. Now they converge to what the Fed is telling us, only 3 cuts. But what if growth is well above potential because of technology or other factors, and then the Fed doesn't cut 3 times, only 2, 1, maybe some people say 0. Last year, revisions of expectation about the Fed in August and September led to a 10% correction of equity. So I think that's potentially, paradoxically, that good news on growth may be bad news for the market if that implies the Fed is not going to cut as much and as soon as people expect now.
So just to put it in a headline, Nuria Rabini thinks the biggest risk is upside risk.
Right now, yes, because the data on Q4 suggests that growth well above potential, and even Q1 suggests that maybe growth is going to be around 3% plus. We're not having a landing of the economy in spite of the Fed cutting rates.
So just to put another headline in this, even Nouriel Roubini is optimistic. I mean, we're looking right now, people looking for reasons to kind of gut check a runaway record rally that we've never really seen in this kind of environment. And the gut checks aren't coming. Does that sort of give you pause, or is this basically a new paradigm where the artificial intelligence and the whole idea of productivity, that you're buying it?
Well, there are several things. First of all, last couple of years, inflation fell without growth slowing down sharply, in spite of Fed tightening rates. And in my view, not because of what the Fed does that pushed inflation lower. We got lucky because there were 3 negative aggregate supply shocks post-COVID that led to lower growth and higher inflation, and they were reversed. the impact of COVID on labor supply and production of goods and services, the impact of the Russian invasion of Ukraine on commodity prices, and the zero COVID policy of China. These were negative supply shocks. They were reducing growth, increasing inflation. Those went away, and that explains why you had still high growth and lower inflation. So it was not the Fed job that did it. It was just we got lucky. And on top of these three positive aggregate supply shocks, now we have a fourth one that is actually much bigger and secular. This is the AI revolution, this technology revolution that probably over the next decade, not this year, is going to increase productivity growth, is going to increase potential growth, is going to increase economic welfare, and is going to reduce cost of production. So I think that's what the market is reacting to.
When we take a look at this period from a historical perspective, are we going to say that helicopter money worked? That essentially that was what allowed the U.S. to act in a very different manner economically to the rest of the world?
I'm not sure, because during COVID, we had a very temporary shock that lasted only a few months. And the policy response, both on the monetary side, was going back to QE, zero policy rates, and we had the fiscal stimulus that by any standard was excessive. And therefore, the resulting inflation we saw in 21, 22 was driven by a policy mistake. I think we did too much, both on the monetary side and the fiscal side, and now we're reversing some of it.
You're sounding so optimism, yet Japan, the UK, Germany, all in recession. We're seeing a lot of stagflation. Do you just view this global growth based off U.S. exceptionalism?
There is an element of U.S. exceptionalism. I wrote recently, actually, an op-ed that was titled Artificial Intelligence versus Human Stupidity. And I point out that on one side, we could be in the best of all times because technology may increase potential growth, productivity, and all those things. But it's more of a U.S. phenomenon so far because most of these innovations are occurring in the U.S. rather than the rest of the world. But on the other side, as in my book Megathreats, I point out there is lots of policy mistakes. There are negative stagflationary shocks, where there is deglobalization and protectionism, where there is global rivalries that are going to fragment the world economy, where there is global climate change, where there is a recurrent pandemic, high private and public debts, sources of inflation, and so on and so on. So I think that we have two forces. One is positive, is going to lead to higher growth, lower inflation, good deflation coming from positive supply shocks. And there are the mega threats that are stagflationary. And the question over the next few years is which one of them is going to dominate.
It's
a mixed bag.
Nouriel, in some of your assessments of each region, you've got the US resilient economy, Europe flirting with stagflation, China continuously declining potential. How concerned are you about the direction of Europe and China currently?
I'm concerned in the sense that actually I'm more concerned about China than Europe. Europe has been in a pretty much stagnation for the last few quarters. The same thing with the United Kingdom. But think of it, given the shock that came from Russia, Ukraine, there could have been a real hard landing. Instead, they've had flat economic activity for the last 4 or 5 quarters. The other problem with Europe, of course, is aging, lack of technological innovation, and things that are more structural. China, I think, is a more serious story because Chinese potential growth used to be, for 3 decades, 10%, then went to 5%. I would say most people now estimate the potential growth for China for the rest of the decade is going to be between 2 to 3%. It's a story not just of aging, it's a story of state capitalism, it's a story of less FDI to China because of geopolitical stuff, a story of less export-led growth because there is protectionism all over the world. Consumer and business sentiment is in a funk, in part because of the policies of Xi Jinping. And finally, consumption is low as a share of GDP, and savings are high because you don't have a social safety net. People have to save for old age, for retirement, if they get sick, if they get unemployed. The migrant workers don't have access to public services. So there are really structural reasons why growth in China is going to be 2-3%. And that's a real shift for the global economy.
Is that a disinflationary shock or an inflationary shock for China to be growing at a much slower pace?
It's disinflationary for China, and we already see it in the data. There's also disinflationary for the world in 2 ways. First way is that essentially China is dumping on global market all this excess capacity. And of course, the Chinese currency weakening means that other currencies are appreciating, and that's also deflationary. And finally, if China is growing less, demand for commodities, everything else equal, will be lower, and part of the global inflation for the last few years has been commodities. So overall, a slowing down China is deflationary for the global economy.
Does that economic malaise risk a more assertive foreign policy coming out of the CCP? Is that what you'd expect?
I'm not sure because they had a very aggressive foreign policy, but I think they've realized right now this kind of a wolf warrior policy doesn't make them friend in Europe or around the world. They have to worry about economic growth. The National People's Congress is right now. They're very insecure. And the reaction to the Taiwanese election has been actually relatively moderate. They could have been much more aggressive. And I think they realize in a situation like this one, escalating tensions with the US is not good for them, is not good for relations with Europe, and they're taking a slightly more cautious approach. I think they're really starting to worry about the economy, about the stock market, and probably, after the Xi Jinping and Biden meeting last fall, there's been a beginning of something of a thaw. I don't think it's a strategic change. There will be continued strategic competition between US and China. The Cold War is going to be like this, but probably for the next 12 to 24 months, the relationship are not going to escalate in the negative direction because they're worried about the economy.
You mentioned the NPC. Can we see any more stimulus coming out of the Chinese government?
Some people have suggested that they should have much more monetary and fiscal stimulus. Xi Jinping and most of the policymakers are resisting it, in part because there is already too much debt and deficits, and doubling down on credit fuel fixed investment is going to be dangerous. But I think that even Chinese realize that the slowdown of growth is structural, is not cyclical. And if you do more monetary and fiscal stimulus, you increase debt, you have a short-term boost to growth. This is only short-term, and you're creating more debt and leverage and more financial risk down the line. So there will be some stimulus, because without that stimulus, their target of 5% for this year is not going to be achieved. I think potential growth already in China right now is less than 4%, but I see growth this year being closer to 4 rather than 5. There'll be some stimulus, because without it, growth becomes on a 3 handle. That's something is politically not acceptable, but not as much stimulus to get you to 5%. So something in between.
More on China a little bit later. Nouriel, this is a pleasure. We're going to continue this conversation. I'm still sort of getting over it that maybe the biggest risk right now for Nouriel is upside risk.
I want to know when the last time was that he was this optimistic. I mean, this is basically...
Well, it's upside for growth, but it's downside for the stock market if that happens.
Well, we'll get to that a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Nikki Haley won her first Republican primary, 62% of the vote in D.C. versus Donald Trump's 33%. The win now brings her total convention delegates to much lower than Trump, who has 244. Now, he is likely to pick up many more in Super Tuesday's vote tomorrow. Amazon's Whole Foods is planning a new small format store for big cities for quick trips. The stores will be between 7,000 and 14,000 square feet. They'll have no buffet bars or meat counters. Amazon signed 5 leases in New York City for the concept. The first one is slated to open by the fall on the Upper East Side. Apple has been hit with a $2 billion fine by the EU over its App Store rules. The EU says Apple abused its dominant market position for the distribution of music streaming apps, preventing users from being sold cheaper deals outside the Apple ecosystem. It's the EU's first fine against Apple and follows a complaint from Spotify. Apple rejected the ruling, claiming regulators failed to uncover credible evidence of consumer harm. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Not a great couple of days for Apple, let's put it that way, on Wall Street either. Dropped from the conviction list over at Goldman to close out last week. Beginning this week, removed from Evercore's tactical outperform list as well. Up next on this program, a massive week on Capitol Hill, punctuated by President Biden's State of the Union address.
Fundamentally, he needs to speak to people who are unconvinced that he's up to the job and people who are unconvinced that he's done a good job.
That conversation is up next, live from New York City this morning. Good morning.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Rain World Cup. This is a three.
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a huge week in politics. Tomorrow, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kayleigh Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
2 days of gains and a 15th all-time high, another record high at the close on Friday, kicking things off this Monday. We're negative by 0.1% on the S&P. Yields are climbing higher by 2 basis points, 420.33. Under surveillance this morning, a massive week on Capitol Hill, punctuated by President Biden's State of the Union address.
Fundamentally, he needs to speak to people who are unconvinced that he's up to the job, and people who are unconvinced that he's done a good job. Those are the people he needs to focus on. He needs to treat this thing, and I think he will, as not only as a de facto campaign speech, but to show that he's on top of the game and on top of the issues.
Here's the latest this week. President Biden's State of the Union address on Thursday, capping off a busy week on Capitol Hill. Voters in 16 states heading to the polls for Super Tuesday, and Fed Chair Jay Powell giving his annual testimony to Congress on Wednesday and Thursday. Bloomberg's Michael Shepard joins us now from Washington, D.C. Shep, for you, out of all of that, what's top of the pile?
Well, you know, we take it one day at a time here, Jonathan. We're really thinking about what lies ahead. The State of the Union will offer an inflection point in a moment for Joe Biden to make his argument to one of the biggest national audiences he would hope to get, and that is in his State of the Union address. But ahead of that, we're going to see a few other things that will bear watching. On Tuesday, we have the Super Tuesday primaries in 15 states in American Samoa. But what we're looking for there is not really the surprise factor. We know that Donald Trump is, you know, odds-on favorite to win in sweeping fashion. What we're looking for is what will Nikki Haley do when it comes to an end on Super Tuesday night when the polls close. And what we're looking for her to do is likely drop out soon after. She has said she will stay in the race through Super Tuesday, but afterward, the math is just not looking to be in her favor.
When it comes to the State of the Union, what do you think Biden needs to say about the economy? Because the polls over the weekend, the Wall Street Journal saying 31% of voters say the economy has gotten better. This is an uptick, but they're still not giving Biden the credit when it comes to that. How does he hammer home this message?
Amory, that's going to be one of the biggest jobs he has on Thursday night, to reinforce that, you know, the tide is turning economically. We've seen the pace of inflation slow significantly. Hiring is continuing. We're not seeing any signs of the soft landing that people have been talking about. Instead, the economy has kept going and going. And so that is a good news case he can present to the public. The challenge that the president faces is that, you know, many voters, including those surveyed in the 7 swing states we polled, find that he may be too old for the job. The concerns about his age come up again and again, and it's not just what he says about the economy and about the state of the nation and about his priorities, it's how he says it too.
Yep, he needs to be compelling, is what the Washington Post says. You know, you mentioned Benny Gantz meeting with the vice president today. How important is him to potentially ink this ceasefire in Gaza before his address on Thursday?
Well, it would be a huge boost to his argument politically here in the U.S. Obviously, the clock is ticking. Given the desperate situation on the ground in Gaza, where hunger and health conditions are so dire, we saw the U.S. dropping air supplies over the weekend there in a signal of how desperate things are and how really significant the situation is. But for Biden to be able to say, look, we have a deal, we will be able to get medicine and food into the territory for at least 6 weeks and hopefully reach some sort of longer-term agreement. But that is, the time pressure is also with Ramadan coming up. That begins on March 10th. And then politically, as I said, at home, Biden is under pressure from Democrats to do something to stop the violence and stop the bloodshed there.
Big time, and has been for the last few months. Michael, appreciate the update. Michael Shepard there, down in Washington, D.C. With us around a table through much of the next hour, Nouriel Roubini. Nouriel, I want to talk about something you've said, which is the biggest election year in history. A lot of people have said that line as well. Is that just purely about the numbers or the significance of the votes that take place this year?
It's not just the numbers, but I would say of all the elections, the most important one actually is the one in the United States, the one that could give us more of policy surprises. You know, India, Modi is going to do well. European parliamentary election, probably vote towards populists of the right, but that's expected as a protest vote. I would say of all these elections, it's 4 billion people, but I'd say the one that actually is going to have a global economic and market impact is going to be the U.S. election.
Do you have a sense of what that impact would look like, depending on who wins in the United States?
Well, I think that geopolitically, many people worry that the policies of Trump, if re-elected on foreign policy, will be very different from Biden. I don't actually think so, because both Democrats and Republicans are tough on China. They're going to remain tough on China. On the issue of the Middle East, Trump, like Biden, realized that eventually normalization between Israel and the Arab states implies something of a two-state solution. He was himself when he was in power. Trump's sort of in favor of it. He's going to play hardball with the Europeans on Russia, Ukraine, but I don't think he's going to give up on Ukraine and give it to the Russians, because he wants to be tough on China. Now he's going to deter China and Taiwan if you're soft. So there'll be frictions, and he wants the Europeans to spend more. So I don't worry as much about foreign policy. I worry about, of course, some of the domestic policy. I think that on economic policy, that's a bigger risk to growth and market. He has said, Trump, is going to impose a 10% tariff on all imports from everywhere around the world. Today, the average tariff rate in the U.S. is about 2%. And he said, in the case of China, he could increase tariffs to 30, 40, even 50, 60%. So you're going to have a trade war, not just with China, but also with your friends, allies in Europe, Japan, Korea, and so on. So economically, I think that's a big risk for the economy, for growth, for inflation, and for the market. It's something that I think people have not yet priced in. Secondly, I think that while there are large fiscal deficits between when Democrats are in power and Republican, he essentially has said he wants to renew completely all the tax cuts that were passed during his first administration. It's another $1.5 trillion, as opposed to just letting them expire. If you do that, you're not going to cut spending, and he said, I don't want to touch entitlement. You'll have another big fiscal deficit, and last year, market started to worry about U.S. fiscal deficit becoming unsustainable. That's when the 5-year Treasury yield went to 5%. So the combination of those two things actually can be really bad for the economy and the market. You could have yields going higher, stock market falling, inflation rising, protectionism. So that's the economic risk.
When it comes to the tariffs, though, you said no one's pricing them in. When would they have to start actually thinking about that?
Well, they don't know yet whether it's going to win or not. The polls say it is ahead, but I think the economy, we know, is doing quite well. Of course, Biden has an issue of messaging, but, you know, strong growth, low unemployment rate, job creation, falling inflation rate, stock market all-time highs, so by any standard. And I think that some of the polls are also biased by partisanship. If you're a Republican, you don't like Biden, you're cranky because of that rather than being cranky about the economy. So there is these biases as well. So I would say for now, we don't know who's going to win. And of course, if he's going to win, then he has to pass these actions. Some of them may require legislation. Some of them may be done by executive order. And people are not yet concentrating on it. He's saying it. They think maybe it's not going to happen. But I think the biggest risk next year, if he's elected, is a trade war and unsustainable fiscal deficits. Those are really big issues.
People just aren't ready to talk about it yet. That's all. Nouriel, stick with us. Nouriel Roubini with us for the next 30 minutes or so. Coming up a little bit later on the programme, Torsten Slok of Apollo on that big call for 2024. He's looking for no rate cuts this year. Coming up next, China breaking 30 years of tradition at the National People's Congress. That conversation with Enda Curran up next.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
I started the program this morning with this stat. I think it's worth repeating. 16 weeks out of the last 18 on the S&P 500 positive. Jim Reed, Deutsche Bank, that's the longest run since 1971. He takes it one step further. If we make it 17 out of 19 this week, it will be for the first time since 1964. This rally has been absolutely phenomenal. Equity futures right now pulling back just a touch. We're down by 0.1% on the S&P, just about positive on the NASDAQ by 0.05%. Bramo, more all-time highs at a close on Friday to kick off with the same thing this Monday morning.
Yeah, 15 record highs so far in 2024. And what I find interesting is normally when you get a rally like this, you get all the pessimists coming out and saying it's unsustainable. Things have gotten a little over their skis. Price to equity ratios look off kilter. And instead you're getting upgrades. You're getting people saying we're not seeing a lot of holes to the thesis that's driving this incredible run.
I'd go one step further. David Costin, Goldman, it's different this time.
Yeah.
It's different this time.
This is really the most dangerous 4 words in finance, and a lot of people will say that, but he's not alone. It's just that everyone's couching it differently because ultimately the drivers of this, the big tech behemoths, have the earnings, have the promise, and have the transformation of the economy that a lot of people are looking for.
And these are the new price targets on the street in the last week or so, the last 2 weeks. Goldman 5,200, Piper Sandler 5,250, Barclays 5,300, UBS 5,400, Bank of America Savita Subramaniam joining them over the weekend 5,400, the very top of the pile. And now the most bullish on the street, and you made this point, it's only 5% upside from here. We're chasing this market as it keeps on climbing.
I like that you say we're chasing this market, people realizing that there's more under the hood. Here are the key questions, though. We were talking about this with Lori Calvasino, who has a different range and hasn't upgraded yet, but could to 54 or 5,500. It really has to do with the economy. It is the black box of whether we are accelerating or whether we are decelerating, and we have gotten it wrong again and again as people were looking for a slowdown. It just has not transpired.
Speaking of getting it wrong, let's just turn to the bond market, getting it wrong about 4 different ways already this year. It's only the start of March. The 2-year last week, this time last week, closed at about 470 on a 2-year, just north of that level for the first time this year. It fell all the way back down to 455 this morning, up a single basis point, Lisa, 454.77. So the low of the year was 4.1, that was January. The high of the year was 4.7. It was only a week ago, and we're back down to about 455 now.
I'm old enough to remember when we were pricing in 6 rate cuts for this year. Right now, we're pricing in far fewer than that, fewer than 4, about 3, in line with what the Fed is expecting. What if Torsten Slok is right, though? What if the Fed does not cut rates at all this year? Is that bearish for stocks, or is that bullish, considering that it would be doing so on the heels of a lot of growth? I don't know the answer to that. I don't think anyone else does either.
You'd think it would be bullish for the dollar, that's for sure. The euro against the dollar at the moment, 108.51. That currency pair positive 0.1%. We will get an ECB meeting on Thursday, which, as we've said a few times already this morning, just doesn't feel quite right that that's happening so early in the month. But anyway, under surveillance this morning, a busy week of eco data and Fed speak on deck. The highlights, Fed Chair Jay Powell giving his annual testimony on Capitol Hill Wednesday and Thursday. In Europe, an ECB rate decision on Thursday. Christine Lagarde widely expected to keep rates on hold for a 4th straight meeting. Then on Friday, the big one, Payrolls Friday, just around the corner. Nouriel, you've been great to stay with us for so long. I want your view on the Torsten Slok call over at Apollo. The no rate cut call for 2024. You've alluded to some of this. You've touched on it a bit already, but how realistic do you think that is? No cuts in 2024?
Maybe no cuts may not be realistic, but I would say that the possibility that the Fed's going to cut rates later and even less than 3 times as they have projected is a meaningful possibility. Growth is well above potential. The Atlanta Fed, no cuts for first quarter is around 3%. The economy, because of AI and technology, might keep on growing, and that may imply that the inflation is going to remain sticky. And I think that's the biggest, actually, potential market surprise. Because last year, as you remember, when people had to revise their expectation about Fed cuts in the second half of the year, you had a 10% correction. Now, this year, in spite of the Fed signaling we're not going to cut as soon as markets want, the market has gone up because, of course, there is the tech story. But suppose that the inflation remains sticky, closer to 3%, and then people say it's not going to be 3, it's going to be 2, it's going to be 1, maybe 0. I think that on net, in spite of stronger growth, the impact of high rates for longer is going to be negative. It's going to be a correction, not going to be a bear market, but there will be a correction, like last year. That will be my guess.
I'm still trying to wrap my head around an optimistic Nouriel Roubini, because this is about as optimistic as I've ever seen you. So are you basically saying that the worst case scenario, just to sort of cap it off, the worst case scenario is that the economy runs too hot, and that potentially, with hotter than expected inflation, it would cause the Fed policy to go a little bit longer than previously expected, which will cause a slight downdraft, but nothing to really write home about. Is that basically the worst case scenario from Nouriel Roubini right now?
For the markets, yes. For the markets, I would say soft landing would imply, of course, that the markets stay high, can go higher. What can lead to a correction today? More than a bumpy landing with a short and shallow recession, it's going to be a no landing. But that's for the US. If you look at the rest of the world, Europe and the UK is mediocre. China is mediocre. Many emerging markets are fragile. Japan is rallying in the stock market, but the economy is just okay. So the rest of the world doesn't look great. I think it's a US story.
Lisa was listening to expand this list, Nouriel. She's got a list of things to worry about. She was hoping that you'd give us some help this morning.
This is not helpful. This is not helpful.
Not helping at all.
No, I don't have anything extra.
Well, as I said, I wrote an entire book titled Mega Threats, where I say that over the next decade, there'll be lots of stuff that can go wrong.
It's true.
There'll be serious stagflationary forces in the global economy. But those are medium-term kind of trends. In the short run, the U.S. economy is doing well. The technology story is right. But as I said, whether it's going to be artificial intelligence essentially rescuing us as opposed to human stupidity having to do the wrong policies. There are plenty of wrong policies. I think it'll be the battle between the two, and there are lots of headwinds in terms of stagflationary shocks to the world over the next decade.
Let's talk about something that could go right down in DC. US lawmakers reaching a deal to avoid an imminent shutdown and fund parts of the government through the end of September. House and Senate leaders will vote on the matter in coming days. The deal leaving parts of the government, including defense and homeland security, facing a March 23 shutdown. That deal will be tougher to negotiate given ongoing disputes, AMH, over the US-Mexico border.
Yeah, that's right. So they've avoided the first deadline for a government shutdown almost. We can all say with confidence they're likely not going to shut down. Falls short of some conservative demands, Jonathan, but there's nothing in here that's offensive to, say, a moderate or even some on the hard right or hard left for voting for this. The issue is going to be when they try to hammer out this defense deal and also funding Homeland Security, because they want the Senate also to take up their bill to impeach Alejandro Mayorkas. So this is what we're dealing with as we look to the end of the March. It's going to be a much tougher negotiation.
I think we're all super happy that we can move past some of this and talk about other things. Let's talk about this. China set to unveil its 2024 economic targets at the National People's Congress tomorrow. The party expected to announce a growth target of 5%. Officials hoping for an economic recovery as the nation grapples with deflation, an ongoing property crisis, mounting debt, and a flight of foreign capital. Economists at JP Morgan expecting policy to stay growth-friendly, but warning not to expect a, quote, bazooka-type stimulus. Enda Curran joins us now to talk more about this. Enda, can we just talk about tradition? The last 30 years, what would typically happen before this and what isn't happening now? How big a change is this?
It's a big change. So the set piece of the NPC every year, John, was a press conference by the Premier, a rare opportunity for the press to put some questions to one of China's top leaders, and of course for the rest of the world to hear from their own mouth what the outlook for China is. Well, this year that press conference has been cancelled, and the Chinese government have made clear that they're also not going to run this annual press conference during the remainder of this current government's term either. So you would have to say, from the outside looking in, that is a curious step. You could almost say a retrograde step for a government that's already under a lot of scrutiny when it comes to transparency from overseas investors. There's a domestic angle on it as well, by the way. You have some China watchers making the point that it's another example of the Premier losing some of his status and all the power going to the General Secretary, President Xi Jinping. So no press conference from the Premier this year. I think it does leave a bit of a hole in the annual, in China's economic calendar.
Speaking of transparency, the past few months we saw China go through the shortest term for a foreign minister, the shortest term for a defense minister. Any update on some of these key political positions?
Well, we know that some of them have been more or less shuffled out of their positions by now. We'll get more detail on all of the personnel moves this week, Anne-Marie. Of course, on the Chinese side, the officials there say that it's not unusual for people to move in and out of government roles. That happens in other governments right around the world. But of course, as you say, in particular with China, we had the defense minister and the foreign minister both having high-profile roles on the global stage, up until a point whereby they no longer were prominent and, in fact, were nowhere to be seen. And that, of course, speaks to this whole idea about the black box element when it comes to looking at China at the moment. A lot of investors and outsiders wondering about what direction the government is taking. A lot of focus on the transparency of the government these days, whether it's economic data or whether it comes to personnel movements in the government. And this week that's why this week is so important. We'll get the roadmap for the government, for the economy for the year ahead. And as you say, we'll get some detail on the personnel moves, which will be very closely scrutinised indeed by China watchers.
And just before we go, what kind of growth can we expect from China this year?
Look, as you say, they're going to expect it to come in around 5%. That's going to be hard given the base effect. Look out for this commentary around high-quality growth, John. That's the key for this year's NPC. Look for what they're talking about. Technology, innovation, and industrial policy. Those are the key sectors to keep an eye on.
Enda, thank you, sir. Enda Curran, down in Washington, D.C. on the latest with China. Just a final word now from Nouriel Rabini of Rabini Macro Associates. Nouriel, if growth in China drops to 2 to 3%, how will we know? Are they going to tell us?
Probably they're going to massage the data, as they always do. But I think there are other indicators of economic activity of China that cannot be manipulated.
What would you look to?
I would look at their PMIs. They're usually a good indicator of what's happening. So sometimes they say 5% growth, but the PMIs right now falling even below 50%. That implies the economy is slowing down, if not starting to contract. So there are ways to gauge what the economy is doing. They cannot lie about everything. Of course, sometimes when some numbers are like youth unemployment are bad, you
just stop reporting
don't
it.
report.
But how much?
Or like when economy is bad, you don't have the premier having the press conference. But it's actually self-defeating because right now China is becoming more and more uninvestable. It's in part because we don't have data, there's no transparency, there's more opaqueness, and then people are living further, both the domestic and foreign investor. So they shoot themselves in the foot thinking that opaqueness is going to help them. It doesn't help them.
Do we have some data in the form of oil prices, iron ore, copper, that have all been much lower than people expected?
Oh, they have, but some of them are driven by demand factors. Other them are driven by supply. For example, in the case of energy prices overall, there's been a significant increase in productive capacity, even of fossil fuels, even in the United States, or LNG and things of that sort. So I would say that historically, movements of energy price or commodity were driven more by demand and reflecting what's happening to global growth or Chinese. But right now, there's also a meaningful shift in supply. Even with the green metals, people said demand is going to grow because of the green revolution. Supply is going to be constrained by regulation. But there's tons of nickel, lithium, cobalt around the world, and some of these mines are coming. And that's why sometimes you see 50% drops in the price of green metals. It's supply-driven as opposed to demand-driven.
A lot of this has been way too constructive. Before you go, just not to disappoint Bramo, this book, Mega Threats, that came out a number of years ago now, time flies. Can you tell us the #1 mega threat that you think hasn't been talked about enough since you published that book?
I would say that people are still underestimating the impact over time of global rivalries on the global economy. So far, the impact has been modest, but I see a world in which the conflicts between a number of revisionist powers, China, Russia, Iran, North Korea, and US, Europe, the West, is going to become a colder war. We already have actually 2 hot wars, one Russia, Ukraine, the other one, of course, Israel and Hamas, but it's just a proxy for Israel and Iran. And the Cold War between US and China this year may not escalate, but over the medium term, I think that the Cold War is going to get colder. There's a risk within this decade that eventually the conflict on Taiwan is going to come to something of a boil because, you know, Xi Jinping wants to pass to history as the man that reunited mainland with Taiwan. So something's going to happen. And so far, I think markets have been calm because these risks have not been materializing or their economic impact has been modest. But I would say over the next few years, geopolitical things are going to get worse.
Nouriel, it's good to see you. Great to catch up.
Great seeing you.
Thank you, sir. The brilliant, the wonderful Nouriel Roubini of Roubini Macro Associates. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Here is Danny Berger. Hey, Danny.
Hey, John. Boeing confirmed it is in talks to buy former division Spirit Aerosystems. The part supplier is at the center of the issues affecting the 737 MAX jet. Boeing saying in a statement, quote, "We believe the integration of Boeing and Spirit Aerosystems manufacturing operations would further strengthen aviation safety, improve quality, and serve the interests of our customers, employees, and shareholders." Shares in Macy's higher pre-market. Investors boosted a takeover bid for the retailer. Arc House Management and Brigade Capital Management increased their offer by 14%. It's now $24 a share. It was $21. That's a 33% premium to the close on Friday. Macy's rejected the bid earlier in January, instead unveiling a restructuring plan where it will close a third of its namesake locations and grow its Bloomingdale's and Bluemercury brands. California and parts of the U.S. West Coast are set to face more dangerous wind gusts and deep snow to start the week, after already days of winter weather blanketed the area with up to as much as 8 feet of snow. The deadly conditions forced road closures between California and Nevada. Amtrak canceled trains across the region. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, making the case for no rate cuts.
Very reasonable case for 0 cuts. Have the Fed pivoting, doing a dovish pivot into 3.7% unemployment with GDP continuing to be strong is really pretty remarkable.
Torsten Slok, Apollo, says no rate cuts in 2024. That conversation up next.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly.
I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Live from New York City, equities pulling back by 0.1% on the S&P. Under surveillance this morning, making the case for no rate cuts.
Very reasonable case for 0 cuts. Real wages are climbing, where inflation broadly is falling, and you're starting to see nominal wage gains really come higher and higher and higher. So the concurrence of that, where you have a Fed pivoting, doing a dovish pivot into 3.7% unemployment with GDP continuing to be strong, is really pretty remarkable.
It's the latest. Investors looking to Fed Chair Jay Powell testimony on Capitol Hill this week for more clues on the Fed's path forward as rate cut expectations are pushed back to summer. Apollo's Torsten Slot going a step further, writing this. The reality is that the US economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. As a result, the Fed will not cut rates this year, and rates are going to stay higher for longer. Torsten, I'm pleased to say, is with us around the table in New York. Torsten, good morning to you.
Good morning.
Okay, big change. Let's talk about why and what underpins it. You've put out 10 reasons in your most recent note. What's the number one reason for you?
I would say the change that we have had since the December FOMC meeting in financial conditions is really dramatic. Think about it, the stock market hitting all-time highs, credit spreads in IG and high yield continuously tightening. January and February saw the biggest credit issuance in the history of going back to January and February. And you also at the same time have IPO activity picking up, M&A activity picking up. So the tailwind that's coming from easy financial conditions is really not surprising that the employment report in January was so strong. It's not surprising that inflation started picking up in January. This is not statistical quirks. This is really a true tailwind coming from easy financial conditions.
So the obvious follow-up question to this then is that if we begin to believe you, does it make rate cuts more likely again?
Well, the issue is, of course, that we need then financial conditions to begin to tighten. And given that's not happening every day, including today, you're seeing more and more signs of easing. And on top of that, also, as a second issue is you're still seeing short-term inflation expectations in break-evens. 1- and 2-year break-evens continue to march higher and higher. How can the Fed cut when inflation expectations are continuing to march higher? It really is a major challenge for the Fed here, where you both have a tailwind as a result of their own actions, but also with the market now saying that inflation expectations are continuously drifting higher.
Do you think this means, given the fact that you are seeing 2-year inflation expectations surge to such a degree, that this means that the Fed's rate policy right now is not restrictive and that it's actually not causing any kind of disinflationary impulse?
Well, that opens up the very important debate about our star and where are we relative to the long run rate. So if we in the long run have to have the Fed funds rate at 2.5, we're absolutely restrictive. But what's most important about this discussion is that the transmission mechanism of monetary policy is hitting very unevenly. It's particularly hitting companies with high leverage. It's hitting households with a lot of leverage. So that's why those entities in the private sector, households, firms, even some regional banks that have a lot of leverage, that are very vulnerable to interest rates, staying high, they are certainly seeing the negative impact. But the rest, at the macro level, you see this in the employment report, you see this in jobless claims across the board. The tailwind from financial conditions easing so much just continues to be really strong.
You had a chart over the weekend that I thought was really fascinating about why this economy has been so rate insensitive, in particular U.S. companies, large caps, saying that the larger companies generally have fixed rate debt, they termed out their debt, and this is the key reason why Fed hikes are having a more limited impact on the economy. They account for a greater amount of the hiring. If that's the case, could you see a scenario where even if the Fed keeps rates at 5.5%, you don't see equity markets go down? They keep rallying, at least when it comes to large caps.
Exactly, because the equity market is dominated by large firms. And exactly as you're saying, Lisa, we have a situation where, as you know, 90% of household debt is fixed rate. And when it comes to corporates, it's slightly more complicated. But you generally have, for S&P 500 companies, they are generally fixed rate. And you have Russell 2000 companies are generally floating rate. So that does mean that there are companies, in particular those with a lot of leverage, those with low coverage ratios, low with relatively weak cash flows. For example, venture capital, tech, growth, in particular venture capital, where you by definition buy companies that have no earnings. Of course, they're going to struggle if the cost of capital stays high. So yes, the transmission mechanism is working as the textbook would have predicted. It's just only working on a certain segment, namely those firms and those entities that have high levels of debt.
Let's go back 12 months. Scene. We're sitting around a table. It's a morning like this one. I get something in my inbox. It's an email from you, and the title of it reads as the following: From no landing to hard landing. The hard landing call from a year ago from you. What happened, and why is this economy turning out to be so difficult to read? Why do we seem to flip from one narrative to the other, back and forth, month after month?
Yeah, no, obviously we went into last year, everyone expecting a recession. We went into this year, everyone expecting 6, 7 cuts. And of course, the economy just continues to turn out to be stronger. I think that there's a number of things, namely that when we had the situation in March in the banking sector, it was rescued by the Fed much.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
Seeing especially the wealth effect and of course financial conditions being generally easy has been very helpful for GDP growth, not only for consumption but also for capex. So the AI story has certainly come in and taken and sucked a lot of oxygen out of the room in terms of all the other things that were going on, and this continues to be still a very important tailwind to everything that's going on.
How long can we keep this divergence going?
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
This is certainly the pain trade. No one is prepared for more rate hikes coming. But I would also say, John, in your world, think about it. The tips market is saying that inflation is a problem, but at the same time, SOFR futures are saying, no, rate cuts are coming. That's inconsistent. You can't have that. You both have a lot of rate cuts, and at the same time, tips markets are signaling that the inflation is going to remain a problem. So I would say the next data point obviously is, well, first of all, of course, Jay Powell on Wednesday, then we have on Friday non-farm payrolls, where my Bloomberg screen tells me 200,000 jobs in the month of February. That's not bad. That's not a slowdown. So it really does boil down to that we are simply not slowing down. Where is the slowdown that we all had expected for so long, including myself and the consensus and the Fed? Remember the Fed last year said we expect a recession in the forecast, and they have taken that out. So I think if we were wrong and waiting for Godot for so long, maybe Godot will not arrive in the next quarter or two either.
Torsten, really thoughtful piece. Always enjoy catching up with you, sir. Thank you. Torsten Slok there of Apollo on why this Federal Reserve won't cut rates in 2024. Coming up in the next hour, we'll continue this conversation. We'll catch up with Darryl Cronk of Wells Fargo, Ed Mills of Raymond James, Seth Carpenter of Morgan Stanley, and a whole lot more. From New York City, this is Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
This is Bloomberg.
I think we have another troubling inflation report that's going to come in March.
Enough people.
UK and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Unemployment at 3.7%.
If anyone looks at those data points and say you need to cut right now, then they're looking at a different set of dashboard indicators than a lot of people are in this market. There is a real question, and Torsten Slok was alluding to this just in terms of who these rates hurt the most. How the sort of compositional aspects of keeping rates higher for longer really do shape, maybe not things when it comes to the magnificent 6 or 5 or 4 or whatever you want to say, but when it comes to the political sphere and just how people are really messaging.
Yeah, let's be blunt. If you're a saver, great times.
Right.
If you're a borrower, not so great.
And basically that's what we've seen with, some of the auto loans absolutely tanking because people can't afford to spend 8, 9, 10% on a vehicle that also is much higher than it has been in the past.
Credit card delinquencies as well, something we talked about in this program over the last few weeks. Let's set the stage for you. Equity markets on the S&P 500 pulling back by 0.2%, just a touch lower here. Bond markets, yields higher by almost 3 basis points now, 420.91 on a 10-year. Coming up this hour, Darryl Cronk of Wells Fargo on why he thinks the market view is too rosy. Ed Mills of Raymond James previewing Super Tuesday. And Morgan Stanley's Seth Carpenter weighing in on the Fed's road ahead. We begin this hour with our top story. Stocks setting a record high on Friday ahead of a monster week on Wall Street, including the jobs report and a double dose from Chairman Powell. But Darryl Cronk of Wells Fargo thinks investors need to take a step back, saying this: the S&P remains near a recent record high, even with the probability of Fed rate cuts this year falling from 5 to 6 down to the current expected 3 over the last 2 months. Lighten up on the top 12 outperformers, including tech. The market view is too rosy. Darryl joins us now for more. Darryl, let's get into that. Lighten up where? We're talking about the Nvidias of this world, the top performers of the last 12 months?
Yeah, I think you can certainly lighten up your equity exposure overall. I mean, I would take it first from small cap, which has been, a relative underperformer, battered and bruised. But I think you do have to lighten up. If you've enjoyed 24% return over the last 4 months, which is what you've gotten, November, December, January, February, 4 months, right? That is impressive. You'd be wise to take a little profit there. To the conversation you were having earlier, remember and recall sage words, wisdom says bull markets die in euphoria, right? To the point, there is no downside that anybody sees at this point. We are starting to approach a little bit of euphoria here, and I think you have to set that context correctly.
Let's get into that word, euphoria. So Savita Subramaniam's come out over at Bank of America. She's gone to 5,400 from 5K. She says any signs of euphoria are thematic and secular. So we're talking about AI, Nvidia, we're talking about GLP-1s, we're talking about Novo Nordisk. Outside of that, where are you seeing what you would describe as euphoria?
I think you're seeing it in, you're definitely seeing it in technology, you're definitely seeing it in consumer discretionary, you're definitely seeing it in comm services, all the leaders that have continued to lead. For markets to really make that next leg higher, you've got to have 3 things happen, right? You've got to have breadth widen out, right? Narrow markets die painful deaths, right? I mean, 2023 was the narrowest market only to 2007. We know what happened in 2008, right? And if you go back and look at other narrow markets, 2020, 1999, 2021. Remember 2021 to 2022, what happened in 22? Big negative returns. What happened in 1999, in 2000, right? So narrow markets don't sustain that leadership. History teaches you that lesson over and over again. So you need breadth to widen out, you need earnings to participate, better fourth quarter numbers, right? We'll take the earnings growth, but think about it this way. If companies, even large cap companies, if their wages are still growing 4, 5, 6%, right? But their top line, we just saw the total sales number grow at 3, let's call it. I can't have my biggest expense line as a company CEO or CFO growing at 4 or 5% and my top line growing at 3 without starting to lay people off, without starting to roll the economy over in that sense.
So you can't talk about 2007 and sort of some of these others in 1999 without really giving some sort of size and scope of what you're expecting. Is lightening up simply because you see a rotation in leadership or because you see some serious downside ahead?
I think you could, so let me put it this way. If you take forward multiples today at 22 times, right, you're in the 90 to 95th percentile of the last 30 years of historical multiples and valuations, right? When you spin the clock forward, when you get in above 90 percentile, you spin the clock forward 12 months, your average annual return is 0%, right? So I think you can probably crest here as earnings catch up, which is often what happens. You pull prices forward, prices reset, and then earnings have to catch up. But let's be clear, they have to catch up, right? I mean, the consensus is still at 243 for earnings estimates today. We'll finish the year probably for 2023, we got 97% of earnings in at maybe let's call it 220, 222, 223, somewhere in there. That's a big jump for this next year. It has to deliver, right? The micro has to deliver. It's no longer about the macro.
How much are you really counting on the Fed to cut rates by 3 or 4 times this year to really keep things on an even keel, if not necessarily going gangbusters, at least not declining materially?
I tend to agree with where the consensus is starting to go to. I think the Fed's going to have a hard time cutting rates the amount of times they want to. What people forget, think about this. So we know we've had goods-based disinflation, right? The goods sector has come down hard. Services, which is 70% of this U.S. economy, you know what the inflation rate is of the services piece of the economy today? 5%, right? Is 5% anywhere close to where the Fed wants it to be? That is way too high and too hot. You couple that with the wage inflation we just talked about, right? And you couple that with also probably losing the tailwind of goods deflation. I think inflation does stay higher. And look, if you look at the bond market, so I went back and looked over the weekend and I was trying to find, show me a period of time where the 10-year Treasury was increasing. Remember, it went up 34 basis points in the month of February. The 10-year Treasury was increasing 3 months before the Fed cut interest rates, and I couldn't find one, right? So rates are still climbing, inching higher, when if the Fed's going to deliver on this May-June timeframe, they should be about facing it coming back down.
Do you then agree with Torsten Slok of Apollo that there's a real chance that the Fed is not going to cut rates this year at all, and that markets can still stay pretty much on an even keel?
I think the Fed desperately wants to cut rates. I don't know whether the data is going to allow them to as many times. I think we're going to have to look at our own estimates, right? But if we don't get, to your very question, if we don't get rate cuts, yes, then I think markets have to reprice from here, because I think the consensus is still too strong that rate cuts cometh, right? And without that tailwind, I think you're going to have a hard time with equities being at the valuations that
Can we just get to the lesson of the last 2 months, though? Because we have gone from 6 to 7 all the way back down to 3, and we've done that painlessly.
Painlessly.
How have we done that?
I think what you're doing is you're papering over what the great lesson I think that we've learned here over the last couple of years is the amount of fiscal stimulus, right? When you look at it's 9% of the GDP, right, is the budget deficit we're running, has just papered over and papered through a lot of what's happening, right? I do think you are going to start seeing markets pay attention if you come down below 3 rate cuts. So if some of the narrative that you're getting today, John, continues in that direction, i.e., 1 or 2 rate cuts or 0 rate cuts, I think markets will start to pay attention to
I think this is a challenge for me because, Lisa, we repriced from 4.1 to 4.7 on a 2-year. We priced out 6 to 7 cuts, and we're pricing in, say, 3 right now. And this equity market carried on rallying. And we'd had this same conversation at the start of the year. Without a doubt, overwhelming consensus would have been we cannot do that without this equity market selling off, and it didn't.
Well, and part of the reason why is because all of the biggest companies, to Torsten's point, have termed out their debt, have fixed rate debt. They've locked in lower rates. They're not necessarily that sensitive to higher rates anyway. And guess what? They're making their earnings continue to rise on the heels of the strength that is not really allowing the Fed to cut rates as quickly as they'd like.
Darryl, before you go, you're not exactly screaming go to cash. There are sectors you do like on this S&P 500. What do you like right now?
Which is the theme of widening the breadth out, right? So I would phrase it this way. Materials and energy on value, on kind of a deeper value and valuation opportunity. And then we still like industrials and healthcare, which have been really strong relative outperformers of late. So I think you can end with that. And I would just, to Lisa and your conversation, I think the great question we have to ask in reverse engineer is, if 5.5% Fed funds slows nothing, right? It didn't slow business, it didn't slow consumer, right? Hasn't slowed government spending, right? Why cut, right? What's the thesis to cut if 5.5% really doesn't become friction in the economy?
It's exactly what Torsten is asking right now. Darryl, it's good to see you. Great to catch up. Darryl Cronk there of Wells Fargo. Torsten Slok basically said break-even rates, what did he say on the 2-year maturity, starting to climb higher. Equities are at all-time highs. To your point, 10-year Treasury yields are rising. It's an odd time with that in isolation, just looking at that specifically, for a Federal Reserve to be cutting interest rates.
Where's the confidence that they're actually going to get down to 2% in any of the data that you just listed?
Not much right now. They need more confidence. Isn't that actually what they're telling us, though? Because maybe a little space to push back would be Darryl saying, you know, they want to cut interest rates right now. They look pretty hesitant to cut interest rates based on the communication we've had.
Which is the reason why it's now plausible that they will not be able to cut rates at all this year. Because if the data continues at this level, then how can they answer the question that Darryl just asked, with the sense we have strong conviction that it's the right move?
2 days of Powell testimony on Capitol Hill coming up a little bit later on this week. Let's see how much confidence and conviction he has. Equity futures right now on the S&P, negative by 0.1. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Boeing has confirmed it's in talk to make Spirit Aerosystems part of the company again. The part suppliers at the center of the issues impacting Boeing's 737 MAX jet. Boeing said in a statement, quote, "We believe the reintegration of Boeing and Spirit Aerosystems manufacturing operations would further strengthen aviation safety, improve quality, and serve the interests of our customers, employees, and shareholders." Amazon's Whole Food grocery chain is planning a new small format stores for Big City aimed at serving quick trip urban customers. The stores will be between 7,000 and 14,000 square feet. They won't have a buffet bar or meat counters. The grocer has signed 5 leases in New York City for the concept. The first Whole Foods Market Daily shop is slated to open on the Upper East Side by the fall. Dune 2 has taken the top spot at the weekend box office. It netted ticket sales of $81.5 million in the U.S. and Canada. That's the biggest opening of the year so far, and the largest since last year's Taylor Swift film. The sci-fi sequel blew past conservative estimates, and some fans packed theaters for 3 a.m. IMAX screenings. That's your Bloomberg Brief. John.
Danny, thank you. I watched Dune 1. I think I left 15 minutes before the end. I have no idea what happened in the movie. Still to this day, do not understand it. And I will go and watch Dune 2, Bramo, just to make that happen.
Wait,
and
seriously?
we'll see if I can catch on. Just see if I can catch up.
Okay, that means that you enjoyed it, secretly. You walked out before you figured you're going back for more?
Big like worms underneath the desert.
I haven't seen it, so I can't wait.
Finish the end of Dune 1
I mean,
before you go see
seriously.
Dune 2.
Chalamet doesn't strike me as like a hero-type character.
What do you think he strikes you as?
Should it be like, you know, some high school dude at Mean Girls or something like that?
Well, he wasn't Wonka, you know.
Yeah, maybe.
Did you see
Maybe.
Wonka?
I haven't watched that yet.
Okay.
I will.
Is that
Not the
next
kind of thing I'd go to the movies for. Up next on this program, a critical week on Capitol Hill.
I do believe that President Biden is getting that sense of urgency. I think we are seeing a campaign that post Super Tuesday is going to go all in on the ground and knows what we got to do to get the job done.
That conversation coming up next, live from New York. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends, we're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's a huge week in politics. Tomorrow, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
So much Dune 2 feedback. Some of you are clearly very passionate about this. So I'll be respectful of the movie, okay? Equity futures on the S&P 500, negative here by 0.1%.
Who are you?
Are you doubting I will be?
Well, okay, what kind of feedback did you get? How could you not like the worms?
No, apparently I'm jealous of Chamelet, apparently. Yields up 3 basis points on a 10-year, 421.50. Under surveillance this morning, a critical week on Capitol Hill.
I do believe that President Biden is getting that sense of urgency. I traveled with him 2 weeks ago. I spent 8 hours with him. They're starting to put the resources we need to see into Michigan. I think we are seeing a campaign that post Super Tuesday is going to go all in on the ground and knows what we got to do to get the job done.
Here's the latest Super Tuesday, kicking off a big political week with voters in 16 states heading to the polls. This ahead of Fed Chair Jay Powell's semi-annual 2-day congressional testimony. President Biden rounding out the week with his State of the Union address Thursday evening. Ed Mills and Raymond James saying this: the State of the Union is arguably more important to Biden than Super Tuesday. This is the real launch of his re-election campaign. I'm expecting a victory lap on the economy and Bidenomics. Politically, voters will be watching Biden's stamina in the speech, and it's a chance to quiet doubts over his age. Ed Mills joins us now for more. Ed, we've heard the president talk about shrinkflation. Can you tell us whether that's landing with the electorate and whether you expect to hear it on Thursday evening?
I have not had a single client or kind of conversation about shrinkflation in the conversations. I think it is part of what he would consider some of the pocketbook issues. He certainly has made a big deal about the junk fee agenda. We could get something this week as well from the CFPB on credit card late fees. But what he's trying to do is take what is sometimes esoteric in DC and connect it to the voter. And on shrinkflation, it is an attempt to say, it is not kind of the policies of DC that are leading to your grocery bills being higher and your products being smaller. They're trying to shift it towards the greed of corporations. I don't think a lot of voters are giving them the benefit of the doubt on that, but that's the political attempt here, John.
Well, and if you look at the polling, and our recent polling as well showed this, is that there you are seeing that the electorate is starting to feel a little bit, slightly more optimistic about the economy, but they still give Biden poor remarks on the economy. So what does he need to say on Thursday that makes the electorate feel good that he can deliver a strong economy if he was given another 4 years?
So we often talk about, kind of it's the economy stupid as the kind of campaign theme in 1992 and how Bill Clinton was able to connect on that. But the other part of that was that he felt your pain. And I do think what is missing out of the Biden campaign so far is that connection that they understand and really are moving policy towards understanding that it's not just a conversation about how, look at how great disinflation has been, because so many times when average Americans go into the supermarket, they're seeing smaller products, they're seeing more expensive bills. We might have an inflation that has gone from, kind of 9% down to 3%, but groceries over the last several years are still up 25%. We're not hitting deflation. So it's a very hard thing to do. So I think what we've seen in the polling data that you mentioned, Anne-Marie, is that so far this election has been a referendum on Biden, and he's behind. For him to turn that around, he has to make it a referendum on Donald Trump and why he would do better over the next 4 years. It's just a question on whether or not he's going to be able to do that.
Well, the Wall Street Journal this morning in their editorial board says now there's panic within Democrats, and they're saying they're counting on a buffo State of the Union speech this week, Trump's well-known capacity for self-destruction. But they end with the fact that if the polls are this bad for Biden in June or July, the pressure will rise for the president to yield to a younger nominee. Is this remains to be just fantasy land on Wall Street?
So every time I have a conversation, and I'm at the Institutional Investor Conference for Raymond James right now about the election, the first thing they ask is there going to be a switcheroo, not only on the Democratic side, but on the Republican side? What we consistently tell folks is that the most likely outcome for this election is Trump versus Biden. But when we look at Super Tuesday and we look at what Nikki Haley said yesterday on the Sunday morning shows, where she was not willing to say that she was going to endorse Trump, increasingly, we're getting the question is, are we going to see a third party run? Is there something about this campaign that we don't know yet that's going to disrupt it? There is a possibility of an open convention or a change at the convention. I just think it's very undemocratic to change that late in the year. And it's a very risky strategy. So it has to be really bad come June, July for them to switch this out at the convention.
The fact that everyone's asking you this and that we hear this also, that basically people don't believe that we actually are getting this rematch, that it appears that we are getting it. Does that mean that people are not accurately pricing the way that they will the possibility of another Trump-Biden run?
Lisa, you're totally right. And I think they're also not looking at what happens after the election. So we put out a report this morning that talked about the most likely scenario is arguably a Republican sweep. The second most likely scenario is a Democratic sweep. And so we're giving about a 65% odds that there's going to be a sweep in this election. And when we look at a sweep, what does that mean? That's budget reconciliation, where all the major pieces of legislation that has occurred in this country in the last 20 years is through reconciliation. We have huge issues on the tax cuts, on Obamacare subsidies. Will the filibuster remain if there is a sweep? So they're kind of not fully convinced it's Trump versus Biden, and they're sleeping on the fact that we could have a sweep of either party. And if it's Democrats, it wouldn't be 50 Democrats that was in 2020 because you had Joe Manchin, Kyrsten Sinema. You'd actually have 50 real Democrats in terms of what they are willing to vote for. Huge market implications if that were to come to pass.
And when it comes to Super Tuesday tomorrow, some of these primaries are closed, some of them are open. What are you looking for in terms of the data? We know that Trump is going to win, but in terms of the data, what can it tell us about his electability come November?
Yeah, Anne-Marie, I think the last time we chatted about this is that you talked about if you had Biden getting the numbers that Donald Trump had in some of these election contests so far, there would be alarm bells in the Democratic Party. We will be watching how much of a ceiling is there for Donald Trump. The best he's done in the big primary so far is at 60%. We're going to look at the data to see, are there certain Republicans who are showing up and they're telling exit pollsters that if it comes to November, they're not showing up again or they're not willing to vote for President Trump. So the size and the scope of the victories are going to be really important to give us that sense of the strength or weakness of President Trump going into the November election.
Ed, thank you, sir. Ed Mills there of Raymond James. Getting us all up to speed on the week ahead down on Capitol Hill. We need to get up to speed on the week ahead for financial markets worldwide. The ECB kicking things off for central banks this month on Thursday. Coming up very shortly, Morgan Stanley's Seth Carpenter weighing in on the road ahead for global central banks, talking about data dependency and how they are dependent on different data points in different ways from the ECB to the Federal Reserve, Bramo, over the next month.
Don't you love data dependency? We're just data dependent.
It frustrates me all the time. I talk about it so much.
I know. Well,
it's like this throwaway line from central bankers.
Right.
We're data dependent.
Right. Which data, how dependent, how much are you going to respond, et cetera. Right now, it's basically show me the money, show me the disinflation. Otherwise, we're going to be patient.
Seth's going to break it down next on this program, live from New York City. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Been a strange morning so far. David Costin of Goldman Sachs saying it's different this time. It was different this time. Nuria Rabini of Rabini Macro Associates saying the biggest risk right now is upside risk, Bramo. Get your head around that.
I was looking forward to the mega threats guy coming out and saying, we got some mega threats. Not so much, maybe longer term or medium term. But this really highlights just how much people are getting on board behind 15 record highs in 2024 and the potential for many more.
An amazing run of gains, another record high on Friday. Equities right now pulling back just a touch. We're down 0.2% on the S&P 500, unchanged on the NASDAQ. Switch up the board and get to the bond market. 2-year, what a ride it's already been this year. A lower 4.1%. A higher 4.7. We're higher this morning by 5 or 6 basis points of 458.72, going into a monster week, Lisa, for economic data.
Especially given the fact that a lot of people say it all hinges with the labor market, at least for the United States. Maybe elsewhere it'll be different. Do you see a fully employed America that have wages that are increasing at continually pace that would suggest an inflation rate above 2%?
I see an America where it's difficult to make a deal happen. This headline just crossed into Bloomberg. JetBlue announces the termination of its merger pact with Spirit. Hardly surprising, AMH, when you see how difficult it is to make a deal happen in Washington.
When it comes to this FTC and this DOJ, they are going after a lot of these M&As, saying that this will be monopoly in the industry. We've seen this in a number of instances, and I think to your point, Jonathan, this isn't a surprise, but it is confirmed now, JetBlue saying that they will terminate this merger pact with Spirit. It's not going to happen.
JetBlue up by 5%. Bramo, we can talk about 3 potential deals. Take one off and make it 2. So Kroger, Albertsons is 1. Another one is Capital One and Discover. Now, if we can't make this happen, what's going to happen to the other 2?
And that's what we've heard from different people. I mean, we heard that from this idea of big banks and small banks alike being able to make transactions at a time where people are saying you need consolidation among some of the regionals. This is going to really be one of the key questions, especially with an administration shift. How different would an administration under Trump versus Biden be when it comes to antitrust? That's definitely something people are looking at.
It's hard to see where the differences are when you have J.D. Vance actually saying that one of the most effective members of the Biden administration is the FTC's Lena Khan, and saying that Google should be broken up. And then you have Senator Josh Hawley agreeing with Senator Warren when it comes to Capital One and Discover. When you look at some facets of the Republican Party and a potential Trump 2.0, they may actually be in line with what we're seeing from this current FTC and DOJ.
Shareholders telling JetBlue what they think about this. The stock is up by close to 8% on my screen right now, Bramo.
Yeah, although we haven't necessarily seen Spirit shares start to trade again since the halt, and I imagine that it'll be the opposite reaction there, where people were hoping for some sort of reprieve after a pretty poor performance.
JetBlue announcing the termination of the merger pact with Spirit, the latest news on a Bloomberg just in the last couple of minutes or so. And the surveillance, our top stories elsewhere. Let's start with this one. OPEC Plus extending its oil supply cutbacks to mid-year in an an attempt to shore up prices and avert a global surplus, a curb of about 2 million barrels a day will remain in place until the end of June. Russia also promising to play its part by focusing on cutting production rather than exports. The OPEC extension was widely expected, but gives oil room to run in the near term. Ample supplies have anchored international prices near $80, even as conflict in the Middle East disrupts regional shipping. Anne-Marie, Brent crude right now, 83.38, WTI, 79.68.
I think what we're seeing here is OPEC put a serious floor on prices. We have seen the cartel really want to ratchet back some of those supplies because they're dealing with slower demand in China as well as ample supplies from the United States. But I think this story gets a lot more interesting later in the year. While Saudi Arabia, we know, is by some accounts needs a much higher oil price, you have a country like the UAE that's sitting on 1.5 million barrels of just idle capacity. They spent all this money to try to get more production, and they're being told they can't use it.
The good news for the president, the crude is lower and not higher. Good news for the president, the gasoline is lower and not higher, because we'd have a very different conversation going into Thursday evening.
The other good news he's not going to talk about, and this, I think, is really one of the key questions, which is basically, is OPEC Plus ceding some of its market share to the United States? The fact that it's cutting and the U.S. is making bank because they're increasing production.
Isn't it ridiculous?
It is, and that's the message that he could be sending, but it doesn't really go to some of the green politics.
Well, Donald Trump, I heard him again the last few days talking about drill, baby, drill. We need to remind the former president that we are north of 13 million barrels a day. It's a record for any country ever, but it's one that this administration doesn't want to lean into.
We don't need to remind him. The current president does, and doesn't want to. And that's the issue at play here.
It talks to trying to speak to different constituencies with rivaling kinds of goals. But, ultimately, the U.S. is that swing producer. And the fact that OPEC Plus is going to keep the cuts means the U.S. can keep trying to take share.
That State of the Union address coming Thursday evening at around 8 p.m. Eastern Time. Oil, crude, gasoline prices probably won't be discussed that much. He's hoping to sway voters on Bidenomics and address concerns about his age. White House aides saying Biden will promote his economic agenda, including the CHIPS and Science Act, as well as a push to kill junk fees for consumers. Biden has also been advancing the idea of raising the corporate tax rate from 21% to 28%, as well as a capital gains tax for billionaires. Let's pick up on the last point, capital gains. They couldn't make it happen this time around. Why are they going to make it happen anytime soon?
Well, I think, to Lisa's point, it's going after certain constituents within your party. This is an administration that, when it had control, Democratic control of the House and the Senate, couldn't close the carried interest loophole. Yet they're talking about raising corporate tax rates. I don't see it happening if we have a divided government, because it couldn't happen when the Democrats had control of the entire government.
Thursday evening, a big evening for the President of the United States. A monster week ahead, not just for the President, but also for Wall Street, including a double dose of Chairman Powell, a central bank rate decision, and key U.S. data. On Wednesday, we'll get JOLTS and ADP private payroll numbers. This as Powell begins his two-day semi-annual congressional testimony before the House. Thursday, Powell testifying before the Senate. Plus, we'll get an ECB rate decision. And Friday, the U.S. February payrolls report. Morgan Stanley's Seth Carpenter joins us now for more. Seth, you framed it perfectly, I would say beautifully, in your most recent note, the Fed versus the ECB. Can you walk us through the difference in being data-dependent in Europe and being data-dependent in the United States?
Yeah, I have to say right now it's a bit more difficult for Chair Powell. I think in the Euro area, President Lagarde and her colleagues, they're looking at inflation. Is inflation coming down? Is it coming down fast enough? They've got weak growth. The German economy, especially the manufacturing part of the German economy, already in recession. Whereas if we look at what's going on in the U.S., and you all at the top of the hour mentioned some of the comments by Nouriel Roubini. I saw Bloomberg headline saying he used the phrase, is the risk of a no landing scenario, i.e. inflation staying high and growth staying high. That's really the tricky part for the Fed. They have to worry about both. You mentioned non-farm payrolls. We've got that coming up. We see a bit of a step back from last month, but nothing particularly weak. So we're at about 200,000 for the month, less than that, 160 or so private payrolls. So slowing down, but not collapsing. And so the Fed really wants to see both inflation continuing to come down and growth softening up a bit, because they don't want an economy that's going to leave inflation 6 months from now, a year from now, above, say, 2.5%.
Seth, I'm sure you heard what Torsten Slok of Apollo had to say last week. Coming into this week, we picked up on those comments with him a little bit earlier this morning. Torsten reckons that maybe you get, in fact, his base case is no cuts in 2024. Seth, what would you need to see in the data for that to become your base case?
I think that's a great thought exercise to do. I'm deeply skeptical that that's where we end up. But what do you need to see? I think you need to see the real side of the economy continue to roll. So 250, 300,000 non-farm payrolls, not just this month, but continuing through all of the first half of the year and into the second half. I think you'd also need to see, though, inflation not coming down. Now, remember, there's been lots of discussion, new data coming out about population and migration. So maybe, just maybe, we could have stronger job growth with inflation coming down. So that, for me, is really the trick for the Fed. They have to look at both inflation, where it is now and where it's going, and the real side of the economy at the same time. And so I think you'd have to see substantial outperformance from both of those variables in the economy.
Seth, Torsten was talking about one of the main reasons why he did revise his view, which is financial conditions and how much they've eased, especially given all of the bond sales, corporate bond sales, IPOs, deals that are trying to get through, even if they're not being allowed. How much have you seen that as materially shifting higher your outlook for inflation and growth in the U.S.?
Yeah, I think the tricky thing with financial conditions really is which particular corner of the world are you looking in, and what's your starting point for the comparison? So I think if you're looking from, say, October, when the 10-year rate was near its peak, through till January, when we had this pretty substantial rally, it's easy to make that narrow case that things are a lot easier. But if we take, say, the corporate bond issuance that's been going on, any refunding, any refinancing that corporations are doing from 3 years ago, 4 years ago, 5 years ago, they're refinancing into much higher rates than what they had been paying. And so I think it's a bit of a double-edged sword. Look at banks. If we look at banks, even though short-term interest rates, the Fed's policy rate has not changed since July, the share of deposits that are sort of retail and low-cost deposits has been going down, whereas the share of wholesale funding for banks, where they have to go out in the market and pay market rates, has been going up. And so there, even with the Fed's policy rate staying constant, the cost of funding has been going up over time since the Fed stopped hiking interest rates. So I don't think it's quite so easy to just say, by and large, across the economy in a wholesale way, everything is just so much easier that it should support the economy.
So, I was struck by something else that Torsten was talking about, this idea that keeping rates at 5.5% is hurting disproportionately small businesses, households, particularly lower income households, groups that are more highly levered and don't necessarily have their assets and savings. How much do you think that's weighing on the Fed? That basically right now, even if it's not crimping the big companies and you're seeing stock valuations continue to rise, there are some real serious harmful effects on a swath of less opulent areas.
I think it's impossible to get away from the idea that monetary policy, which is a very blunt tool, has a differential effect across different folks across the economy. I remember way back when I was a professor, I wrote a paper on the sort of asymmetric or the differential effects of monetary policy across the economy. So I think that's very, very real. And I think the type of crimping that you're talking about is, unfortunately, exactly what you would expect. Monetary policy is blunt. It is the Fed raising the cost of borrowing, and so necessarily the people who will be affected more will be the ones who have more borrowing needs than others, those who have less alternatives in terms of how to get around the higher cost of funding. So I think that point is exactly right, but it's also very much the way that monetary policy has always worked. It's not it is potentially a bug, it's potentially a feature. It is, in my view, just a fact of how monetary policy works.
Seth, forgive me for finishing on this, but I want to inject a little bit of politics and ask you this. Shrinkflation, price gouging, their contribution to headline inflation, is that a good political argument or a strong economic one?
Oh, I mean, I think this is a real challenge, and this is where I am constantly reminded that as an egg-headed economist, I am not a real person. I talk to my family, I talk to friends who have nothing to do with the macro scene, and I say, look at that, inflation's come down a lot. And their reaction is, I am paying more than I was 2 years ago for just about everything. How can you say that inflation has come down? And of course, the answer is there's a difference between the price level and the rate of change of the price level. But in terms of politics, which is where you started, perception is reality. And I do think part of the reason why we're seeing the polling numbers so negative on the economy is the fact that the price level itself is still much higher than it was a little while ago.
Seth, perfect answer. Thank you, sir. Seth Carpenter of Morgan Stanley. Appreciate it, Seth. Good to see you. How many conversations have you had like that with family members?
I don't even try.
The world over.
Yeah, I mean, basically everyone's probably not trying to explain inflation. The inflation rate is coming down. And they're like, did you see my grocery bill? Did you see my rent?
Yeah.
What are you talking about?
What was it 4 years ago, before the pandemic?
I mean, basically,
I know.
It's a matter of time.
That's the challenge for the president on Thursday evening, to try and connect with those people. Equity futures right now on the S&P, negative here by 0.2%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of JetBlue are rising after the company announced the termination of its merger pact with Spirit. The July 2022 merger of the two airlines had been valued at $3.8 billion, but the Department of Justice sued to block the deal, alleging it would stifle competition in the airline industry. The CEO of JetBlue said in a statement, quote, "We believe this merger was worth pursuing because it would have unleashed a national low-fare, high-value competitor to the big four airlines." Apple has been hit with a $2 billion fine by the European Union over its App Store rules. The EU says Apple abused its dominant market position for the distribution of music streaming apps, preventing users from being told of cheaper deals outside the Apple ecosystem.
The Commission found that Apple's rules result in withholding key information on prices and features of services from consumers. As such, they are neither necessary nor proportionate for the provision of the App Store on Apple's mobile devices.
It's the EU's first fine against Apple and follows a complaint from Spotify. Apple has rejected the ruling, claiming regulators failed to uncover credible evidence of consumer harm. NVIDIA has notched another milestone. It's now the world's third biggest company. The chipmaker's rally drove its valuation past $2 trillion for the first time. NVIDIA's Friday close put it third on the list behind Microsoft and Apple. NVIDIA shares have risen more than 66% this year. That's your Bloomberg Brief. John.
Danny, thank you. Message from a Bloomberg subscriber just across the Bloomberg right now. With Rabini turning around, now I'm worried. Now I'm worried.
See?
I've seen a lot of that.
I know, but then it's like, really? That's what you're also going to get? I also did get a message on the Bloomberg saying, no, the opposite. Really? You're worried that there aren't enough people worried? Was that really how low you've stooped?
If you missed it a little bit earlier, Nouriel Rabini saying the biggest risk right now is upside risk. Up next on this program, Macy's gets a better offer.
We are very hopeful that we can increase our offer if we get access to that relatively limited diligence that we need. And for that reason, we've made the request. The response was, unfortunately, from the company that it was premature to even begin negotiating an NDA.
That conversation up next, live from New York City. Your opening bell 45 minutes away this Monday morning. Equity futures on the S&P 500, slightly negative. We're down by 0.2%.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Was you were offered a money-losing women's basketball team And you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
.42 minutes away from the opening bell. Equity futures on the S&P negative here by 0.2%. Yields bleeding higher by 4 basis points, 4.22 on a 10-year. The euro a little stronger against the weaker dollar, 108.46. So raising some of that strength though as the session progresses. Under surveillance this morning, Macy's getting a better offer.
We are very hopeful that we can increase our offer if we get access to that relatively limited diligence that we need. And for that reason, we've made the request. The response was, unfortunately, from the company that it was premature to even begin negotiating an NDA. We've expressed that to Macy's. We've walked them through our capitalization. And on multiple occasions, they've told us, you know, over the last 7 weeks that they had no additional questions with respect to our financing.
Here's the latest. Ark House and Brigade Capital raising their bid for Macy's, now offering $25 per share to take the company private. Macy's still reviewing the offer after unveiling a restructuring plan, which would close a third of U.S. locations. Sucharita Kodali of Forrester Research joins us now for more. Sucharita, can I ask you then just bluntly up front, does this get the deal done?
Well, I think it really depends because there are still a lot of unknowns. Macy's doesn't have the answers that they had asked for before on how the financing was going to happen. And the buyers, it sounds like they don't necessarily have all of the details from a due diligence standpoint that they had asked for either. So there are a lot of things that are still in the air. The numbers seem to look attractive, but whether or not they can actually make it happen in this high interest rate environment, I think, remains to be seen.
Let's say they can. Do you have a decent understanding of what would happen to this company?
Well, typically the playbook when there is an acquisition of this sort is that usually the assets are harvested and there is essentially a slow decline in the retailer. And the biggest assets here are really the real estate properties. What's going to happen with that Herald Square store and other assets that they may have that are physical bricks and mortar stores. So that's really the question. I think that they will probably try to persuade the shareholders of a slightly different story, that they will preserve jobs and they'll preserve the locations that have been announced, that they'll stay open. But I think that it is hard to envision that they will be able to turn that the department store sector in general, or the apparel sector, is going to have a major turnaround that would reverse the fortunes of Macy's anytime soon. So I unfortunately do think that this is probably headed into the direction of maybe, the outcomes of some of the other private equity retail acquisitions that have happened over the years.
Where it really is about the real estate more than anything else. Given that, what do you think has gone so wrong at Macy's? Do you think it's just an environment issue that the department store is having a hard time, or do you think that it's a Macy's-specific issue that's caused its shares to drop 10% this year and a whole lot last year and the year before?
Well, I think a lot of it are the macroeconomic factors. The truth is that the entire department store sector has been under pressure pretty much since 9/11. It kind of peaked around the year, 2000, 2001, and has been just on a downward trajectory since then. A lot of it is due to competition. It's everything from companies like Amazon that have been in their space. It is the mass merchants that have encroached the apparel category more and more. It is specialty retailers like Sephora. And increasingly now, it is new Chinese upstarts like Shein and Temu that are absolutely eating into these kind of sales of the department stores. Now, has Macy's executed badly? I think that they have done pretty well given the circumstances. They've leaned heavily into sectors like private label, apparel, and other merchandise. They've opened these small format stores. They have leaned into luxury with Bloomingdale's, which is relatively resilient. But the truth is, it's not enough. The Macy's flagship brand, which had been, for the most part, a series of a lot of department store acquisitions over time, it's just been really, really challenged. This is one of the apparel is one of the toughest sectors in retail overall. Department stores are really challenged even within the apparel sector.
So what's your sense that if this transaction goes through, it'll be basically broken up, sold off for the real estate, and just sort of left as a vestige of its past?
Well, that is, or it could go into bankruptcy. I mean, there are any number of outcomes. I mean, you see this in the office supply sector. You see this with what happened to Toys R Us. I mean, private equity and kind of acquisitions of this sort just don't necessarily. I've seen very, very few great outcomes for retailers, and that's why I am a little skeptical for the future of Macy's. Skeptical about the future of Macy's. But that said, at the same time, I don't necessarily see a path for them to get back to stock value, stock price of $70 either. So given that outcome, this may actually be, from a maximization of shareholder value standpoint, the best that they've got at this moment in time. I also think one consideration is that commercial real estate is essentially an entire an entire city block there. And the big question is, in a better environment, could it have basically unlocked more value for the retailer?
Do you think if this deal was to happen, they would go through with closing almost a third of those shops, though? And can you see them leaning in more towards this luxury retail?
Well, they'd already announced, even kind of separate from this deal, 150 store closings, and I don't think that anything is going to change or reverse that. It sounds like they were very, very underperforming stores that barely generated any revenue for the brand altogether. In terms of can Bluemercury and Bloomingdale's solve their problems, the issue is that Bluemercury in particular, while likely high margin and very, very strong from a consumer loyalty standpoint, it's a small format store and it's only going to generate so much in revenue. It's never going to offset the revenue that a larger format department store could be able to generate. They'd have to open a heck of a lot of Bluemercuries to make up for one Macy's store. And as far as Bloomingdale's is concerned, there's potentially some promise there, but the challenge in luxury.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need.
like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo.
Ship around, you've already taken the gold. I go, that's right. I'm always going to be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
Making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
$2 billion antitrust fine. We begin with the big issue of the day, investors bracing for a monster week ahead.
The next data point obviously is, well, first of all, of course, Jay Powell on Wednesday, then we have on Friday non-farm payrolls, where my Bloomberg screen tells me 200,000 jobs in the month of February. That's not bad. That's not a slowdown. So it really does boil down to that we are simply not slowing down. Where is the slowdown that we all had expected for so long, including myself and the consensus and the Fed?
Let's preview the week ahead. Mike McKee is with me side by side. It's going to be a monster week. Mike, good morning.
Good morning, and it is going to be led by Jay Powell, who goes up to Capitol Hill to testify before the House on Wednesday, the Senate on Thursday. He's not really a PowerPoint guy, but if he were, this is the chart he would show. This is both CPI and PCE inflation, the two big measures, and you can see over on the right-hand side the story they tell. The Fed has more work to do, and that's probably going to be the heart of his message. We're in no hurry to cut interest rates, which is kind of not what they're going to want to hear up on Capitol Hill, at least not the Democrats. It's almost Shakespearean. Go back to Macbeth, and if it were done when 'tis done, then we're done quickly. Nope, not from the Fed. Sherrod Brown, who chairs the Senate Banking Committee, quoted earlier this year in a letter he wrote to the Fed, urging them to ease monetary policy early this year. Just a week ago, Donald Trump was out saying he thinks that the Fed is going to do something to help Democrats if they lower interest rates this year. So going to be a lot of questions about whether the Fed is not only going to move, but what their motivation is if they do. So we'll watch for that. And then other plot lines, Powell is testifying ahead of the State of the Union, remember, so a lot of politics up on the Hill this week. They'll be asking him about the budget deficit. Whose fault is it? Republicans say Democrats, Democrats say Republicans. He'll try to stay out of that. New banking regulation and capital requirements. This is a bet noir for Republicans on both the Banking and Finance Committee. The Fed is looking at new regulations that would raise capital requirements, and that is something that they are going to be, Republicans probably attacking him about, and the Elizabeth Warren camp praising him for. And then, of course, everybody wants to know about the balance sheet rundown, and the politicians will probably question him about why the Fed is losing money on all this. So a lot for Jay Powell to talk about, perhaps more than usual, with this whole idea of when does the Fed cut rates and why would they do that hanging out there.
Okay, Mike, good to bring a bit of Shakespeare in on a Monday morning. Michael McKee setting the agenda for the week. Let's start the conversation with State Street's Laurie Heinel and PGIM's Greg Peters. Good morning. The issue is this. We've even got Nouriel Roubini coming into the studio saying no landing. I mean, for a perma-bar, that's quite a statement. So, Laurie, let me begin it with you. Does Powell double down on this no rush to cut? And are you in the no landing camp?
Well, first of all, I think Powell does double down on the no rush to cut because he's not going to want to be seen as being influenced by any particular data point. Having said that, we believe that the Fed is already a bit behind the curve. In fact, we're thinking that they should start cutting, if not in March, certainly by June. And part of that is that despite the fact that the U.S. seems incredibly resilient, there are signs of weakness that are starting to emerge. And beyond that, we don't think that a 5+% interest rate is consistent with an economy that's likely to be growing closer to trend.
Well, let's take this argument a little bit further. The last time we heard from Jay Powell was on 60 Minutes, and this is what he said. The danger of moving too soon is that the job's not quite done. And that's really good readings that we've had over the last 6 months somehow turn out not to be true, an indicator of where inflation is heading. Now, Peter, of course, if we bring that across to you, oh, sorry, Greg, if we bring that to you, we've had CPI, PPI, and a PCE, which is slightly above trend. So, Laurie, I get your point, which is they're behind the curve, but the evidence gives them cover, doesn't it, Greg?
Spot on. I mean, I don't understand the obsession with what Powell is going to say. It doesn't matter what he's going to say. He's going to follow the data. And what is not being talked about nearly enough is market expectations for inflation have increased pretty substantially, right? So if you look at 1 year inflation break-evens, they're double where they were last year. So they're 4%. 2 years at just call it 3%. So inflation per the market is moving the other way. So focusing on Powell and how he tries to finesse it, I think misses the central picture, which is what is the data telling you? What is the market telling you? And everything else is just white noise in my mind.
It's always good when you get a guest to come on the show and go, it just doesn't matter what Jay Powell says this week. That's why we have you on. But then that takes us very naturally to the Torsten Slok narrative, which is the risk off, Greg. No cuts 2024. Let's pit the two of you head to head here, Laurie. If you say it doesn't matter and that the data and the break-evens are breaking higher, therefore you will come into the camp of 3 cuts or less?
So again, we're still in the camp that the Fed is behind the 8 ball. And part of the challenge is that they were behind the 8 ball when they started to fight inflation. So they're going to be even more measured when they start to cut, in part because they maybe learned their lesson a bit. And I don't think that it doesn't matter. There's a lot of room between where we are now and where we were before we went into this rate hiking cycle. So again, our view is that when you have long-term growth expectations anchored somewhere around 2% here in the US, and you don't have inflation that warrants a rate of 5 or 5.5%, then there's a lot of room there for the Fed to make some adjustments. And I think the other thing that we're starting to see is that there's a lot of vulnerability. Corporate profits continue to hold up in here, but as you continue to see some of this repricing factor into the market, that will be more pressure on companies to be able to deliver against a backdrop where they're still absorbing a lot of this tight policy.
So, Greg, if you are looking at the break-evens, and that's just one portion of the narrative I know that you're looking at, Do you fall into the camp then that you could see where Torsten Slok is going, is that there is a case for no rate cuts this year? If the break-evens are moving higher, if the narrative is that inflation is not as under control, well, it's steady, but it's just not slicing down to 2%. So does that build on the argument that you could have 3 or less rate cuts this year?
Yeah, so our base case has been all along 50 to 75 basis points of cuts, so modulating rates lower. But I think what is highlighted by what Torsten's saying is that the market continues to lean really the other way, right? So the bias in this marketplace is much more dramatic rate cuts, right? And you saw where we were at the beginning of the year. You see it when any kind of swoon in the marketplace, the market instantaneously prices in a dramatic rate cut environment. And that just doesn't hold in our estimation, given where inflation is, given where growth is. So I think what Torsten is really just highlighting is that the risk in the market is that they don't cut at all, because the market has continued to lean into this notion that you will see rate cuts in even more than 50 to 75 basis points. So that's the bias.
How much of a risk, Greg, then would that be to the bond market? 10's trade at 422 this morning. Given the narrative that we've just discussed, would that be materially disruptive to rates? Would it be 4.5%? Would it be 5%? And would you be a natural buyer on those riff higher?
Yeah, so I think it pushes everything higher for sure. So if you don't see rate cuts coming in, the front end will continue to adjust higher, which will move the entire curve higher. But you'll still continue to have this inverted curve, at least as tens, 2s, 10s, and 2s, 30s. So the market will continue to kind of have this inversion being priced in, which is to say they're not really buying into the notion that, we won't have rate cuts at all. So I do think there's a repricing. I think it'll be a gentle repricing, but it's really about what the data says behind it.
So if I look at the whole narrative, Laurie, over the past couple of days, Goldman Sachs have been with us, a number of other houses have been with us, putting out their new notes, 5,500, 5,400. I look at Bank of America this morning again, coming in with 5,400, and Subramaniam writing this. Bull markets end with euphoria. We're not there yet. Sentiment has improved, but their areas of euphoria are limited. If you think that the Fed goes earlier, perhaps than Greg does, would you think that that's supportive to the equity market narrative? And would you agree that we are not in some kind of euphoric, distended level of excitement in these equity markets?
Well, from an overall equity market standpoint, we're not in that euphoria distended period. There certainly are stocks that we think are at nosebleed territory, and they just keep plumbing higher highs. So it's hard to know when that will end. But there is a lot of opportunity for the market to broaden out. We started to see that earlier this year as we saw more participation in things like the value factor and the quality factor and other elements that are potentially there to drive the markets higher. But I think it's important to keep in mind that part of what will dictate markets over the balance of the year is what's the backdrop, not just what the Fed does, but why do they do it? So if we're right that economic activity is likely to continue to slow, and against that backdrop, the Fed is starting to ease policy, then you could have a market that stagnates a bit or perhaps even corrects a bit because there's this recognition finally that things aren't going to go on forever and there are market cycles still.
Greg, what would this scenario do to credit? I look at triple B to double B. Those are incredibly whip thin, they're razor thin spreads in credit at the moment between the areas. Given the scenario you've outlined this morning, do you think there's any pinch points in credit?
Yeah, so I do think higher rates, all else equal, puts pressure on over-levered capital structures. It just takes time, right? Because there has been this debt term out trade over the past several years. So the longer that these higher rates persist, the more stress and strain you'll see lower down the scale. So we continue to see real opportunities in investment-grade corporates. So investment-grade corporates last week really sold off pretty meaningfully based on supply. But I think that misses the story for the balance of the year. So we've seen unreal net supply hit this quarter, but after that, it really turned severely the other way. And there's such a demand for credit that I think the trade for the balance of this year is high-quality credit as a result.
Well, certainly we've seen the floodgates open on the supply side. Greg, thank you very much. Stay with me. Laurie Heinel, Greg Peters, my guest, kicking off this Monday morning for a pretty big week on risk. I can get my words out. It's Monday morning. Stocks are moving ahead of the opening bell. Lots of flow and news. Abigail is with me.
Indeed, Manus, and we do have the S&P 500, the NASDAQ, slightly lower at this point. Those futures being weighed on in part by Tesla. Shares down more than 1%. This after shipments from China fell to the lowest level in about a year. They shipped just over 60,000 vehicles, down 16% month over month. Investors truly not liking that. On the other hand, Supermicro Computer, this is amazing, up 15.5%. Stock being added to the S&P 500, so managers will have to index to it, or at least those index managers will be forced to buy it. Into today, over the last year, up an eye-popping 821%, really pretty incredible. And then Coinbase up 6%, in line, being helped out by Bitcoin higher. And then, of course, last hour, we did have that breaking news around JetBlue and Spirit Airlines. JetBlue is letting go of that $3.8 billion bid, troubled by lots of regulatory factors. Spirit plunging even more on this, down 14%. But JetBlue Airway investors, they are clearly happy, relieved, up 5.3%, Manus.
Yep, they are. And they've been given a little bit more guidance. Abby will dig into that story shortly. Abigail Doolittle, as ever, side by side on the stocks and sectors. Coming up on the show, the U.S. consumer in the spotlight.
The entire department store sector has been under pressure pretty much since 9/11.
Retail earnings continue rolling out throughout the week. The conversation continues on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
The entire department store sector has been under pressure pretty much since 9/11. It kind of peaked around the year 2000, 2001, and has been just on a downward trajectory since then.
U.S. consumer confidence falls for the first time in 4 months. That was in February. Optimism on financial conditions fades. Will we get a clearer picture this week thanks to a number of those retail earnings? Target, Ross Stores both report tomorrow. Foot Locker on Wednesday, and the week rounds out on Thursday. Costco and Gap joining me now to put context around the U.S. consumer. Simone Foxman. Simone, what have we got?
Yeah, Manus, we could see the divergence between those retail winners and retail losers really on display this week as investors try and parse all these earnings calls for signs about the health of the consumer, whether or not they are weakening. On the discount, we are expecting a lot of those big discount names to really show some same-store sales gains. Burlington same-store sales, for example, could be up as high as 11% year-on-year. Costco, the street is looking for about a 7% rise in same-store sales. At the same time, though, everyone's expecting to see a bunch of weakness on those consumer brand names, the likes of Target down 4.6% consumer sales expectation. Foot Locker could be down as much as 7%. So that real divergence expected to be on display. And this, in the past quarters, is what's really driven a lot of the confusion around exactly how healthy this consumer is. Also, watch out for mentions of shrink that has taken a toll on some shares over past quarters as well. All of this, however, coming in the backdrop of maybe a rise in M&A, especially related to Macy's. Over the weekend, we saw Brigade and Arkhouse boost their offer by 14% to buy all the shares of Macy's they don't already own. Their offer at $24 a share now would put the value of that company at $6.6 billion. Macy's, of course, rejected an earlier offer, saying it didn't provide compelling value. We will see if this offer is enough to change their minds, Menace.
Okay, certainly a kicker there, up 15.38%. Simone Foxman with us there on the retail front. And we will get more information and break those throughout the week with you. My guests this morning are Laurie Heinel and Greg Peters. Greg, I want to bring it to you from the context, from the macro context. I look at the savings rate during the pandemic. It blew out by 30%. That's gone. We're now down to a savings rate of 4.6%. We are at an inflection point in the consumer. And I just wonder how much, if at all, do you extrapolate the dip in confidence in February with this dissipation in savings? It's almost as if we're about to turn over the hill in terms of the momentum for the consumer. Translate that for me.
Yeah, so I think first and foremost, the consumer confidence data is really quite, let's use the word squirrely of late. And so there's been some data issues there. So I would put that to the side. But, the consumer is fragile for sure. They have blown through their savings. That is something that we're focused on. But there's two other items that I think are important. First is on the wage front. So you're finally seeing real wages improve across a broad swath of labor in ways that we haven't seen in quite some time. So I think that is a positive. And the second is higher interest rates on just their savings accounts, right? So I think those two items are new entrants into consumers' psyche, and I do think that matters. But at the same time, I have to admit it is fragile. It bears watching, no pun intended. But we're hopeful on that front.
Laurie, do you share the sort of the question mark beside the consumer? It's interesting, Greg, obviously talking about the interest that we're receiving, but I would say back to you, Greg, on the other side of that trade, which is look at the blowout in sort of credit card spending by the consumer. Laurie, your riposte to the question mark against the U.S. consumer.
Yeah, we think that the U.S. consumer is showing a lot of weakness in here, and we've been pretty much underweight both staples and a lot of the discretionary spaces, in part because of that weakness on the part of the consumer. And then you add to that some of the sort of natural things that would buoy consumer spending, like household formation, home sales, things of that nature. And we just don't think that there's a lot of value to be had there. The one place that we do still see some opportunity is in some of the luxury goods space, where there's just less concern about that cohort's ability to continue to spend in here.
One global story, and actually it plays a little bit into the luxury sector, Laurie, that you mentioned, is about China. We have this national convening, growth rates, communication, policy responses to transmit to the Chinese economy. Laurie, from your perspective, how important is this week from a global growth perspective that China delivers?
Well, certainly we all know the China story. It's pretty well telegraphed. China is slowing. They have vulnerabilities. They've got lots of issues, including the ongoing stresses in their real estate environment. And they'll continue to do things that at the margin can support their growth and can keep them from growing even more slowly than they already are, including doubling down on exports, manufacturing, things of that nature, which actually does have a positive feedback loop in terms of exporting deflation to the rest of the globe. So it is critically important, but I think that the punchline is still that China has a lot of work to do ahead of it and fewer policy tools than it once had.
And Greg, just to close off from the bond perspective, many people have said to me, everybody tailwinded the Fed on the way up, but it's other central banks, the UK, the ECB, along with emerging markets, which are going to have to be more aggressive in their cuts. They're not going to be able to afford the same latitude of wait and hold briefly. How does that play into the narrative for rates?
Yeah, so I think what you're seeing outside the U.S. is a lot less strength for sure. You look at Europe, you look at China, even Japan is going the other way. So this is decidedly a U.S. strength story as it currently stands. So when you think outside the U.S., you do have to envision more aggressive in terms of rate cuts. But there's also this pesky thing called inflation there too. So, that is a binding constraint for some policymakers. But at the end of the day, we see this as a U.S. Exceptionalism story, and I think it'll bear fruit via rates.
It's a very consistent theme. Exceptionalism in terms of the dollar, exceptionalism in terms of the cross-asset allocation here to the United States relative to the rest of the world. Thank you so much for being with me, setting the stage. Laurie Heinel, Greg Peters, on your risk map for this week ahead. Coming up, morning calls, and later I will be joined by Bank of America's Jared Woodard. He joins me to make the case for stocks over bonds, and conversation still ahead on this, the opening bell.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Be nervous on a week that you've got State of the Union, you've got Jay Powell. Well, Laurie Heinel over at State Street just left us a message. The Fed will go early and probably go quite often. That is the mood in the markets. That may get you up to speed with what the scribes are saying on Wall Street. RBC Capital upgrades lift to outperform, seeing the upside stemming from potential partnership with DoorDash. UBS upgrades Norfolk Southern to a buy, expecting strengthening in margins, a better performance from its merchandise network. And finally, Goldman Sachs removes Apple from its conviction list of top buys, highlighting the stock's recent underperformance amid concerns of slumping demand. So we're going to catch up with Jared Woodard of Bank of America Securities. The year of the bond, take 2. We'll talk about credit, equity bonanza right now.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock, yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
They're happy the NASDAQ there. Healthcare solutions from TrueBridge. Not just as ecstatic on equities at the moment. State Street say you'll get early cuts, fast and furious. Apple is dragging us just a little bit lower. A $2 billion fine. That is the EU showing the teeth. We're rolling over to an opening. We're still above 5,100. Critically important psychological level. Ms. Subramaniam over at Bank of America says, we are not in a euphoric state at the moment. And indeed, euphoria has yet to arrive in these equity markets. You may be euphoric in Bitcoin, above $65,000, up 4%. That's carrying through for some of the overall platform providers in that space, the likes of Coinbase, flying higher. 10-year yields are up this morning. Again, there is this building narrative. Nouriel Roubini with the team this morning on surveillance. No landing, less rate cuts, higher yields. Does that make it appealing at 4.5% to step back in? That is the bond story on the Bloomberg today. Oil up 0.4% as OPEC Plus extend their 2 million barrel a day cut through the second quarter. And Russia will step up to the plate in terms of doing their bit to sustain stabilization in the oil markets. To the retail market, Macy's at the open here. The shares are jumping, flying higher. Investors see increased takeover bid of $24 a share. That is a 14% premium to the prior offer. Abigail Doolittle has the narrative. We're up 13%.
We are up 13%. It's the best day for Macy's since December of last year. And we've seen this story before because, of course, last year we did have Ark House and Brigade Capital Management come together with an offer for Macy's, which was rejected by Macy's, saying that it just didn't really unlock the value that they wanted to see. So now they have upped that price, and to Friday's close, it represents a 14%, or excuse me, a 33% premium to Macy's Friday closing price. Right now, nearly at $21. Now, they rejected that bid in January. Excuse me, it wasn't last year, it was earlier this year, saying that it lacked the compelling value, and then have instead, most recently in the earnings report, unveiled a restructuring that includes closing 150 stores in the U.S. A lot of folks saying that their real estate is one of the more valuable pieces of their business. Macy's did confirm that they have received this proposal, and they are saying that they will carefully and review and evaluate that offer. Again, the stock up 16%, the best day of the year. Macy's investors like it a lot, Manus.
Go Macy's. Abby, thank you very much. Let's turn our attentions to the airline space. JetBlue formally abandoning its pursuit of Spirit Airlines. More than a month after a judge blocked the $3.8 billion acquisition. So it's doors to manual at JetBlue, Simone, and it looks like the investors are cheering the stepping back by JetBlue.
Yeah, they're certainly cheering JetBlue, but not so much Spirit Airlines this morning. There were serious doubts that this deal would arrive on time, despite the fact that both airlines had been fighting this ruling. But the deal was required to be completed by July. And this is something that JetBlue had noted back in January after that judge's decision, and that it would violate antitrust laws, driving up prices, eliminating competition. But the companies had really been vowing to fight this as recently as last week when they had asked for oral arguments in their appeal to be in June. But now we've seen ultimately this decision come. It's unclear if Carl Icahn influenced the decision on JetBlue's side. He recently got a pair of board seats after acquiring about 10% of the outstanding shares. JetBlue will pay Spirit $69 million in breakup fees. But this is a real concern for Spirit because it's not clear how the company is going to go ahead and finance its $1.5 billion of debt maturing this year. It said in a similar statement that it has retained Perella Weinberg as an advisor. Analysts believe that we could see a bankruptcy reorganization or even a liquidation of the deep discount carrier. Bloomberg Intelligence, back when the company reported earnings early February, said that the end of this deal leaves the airline with few options, Manus.
Yeah, it could be a precarious time for them. Simone, thank you very much. Simone Foxman on the airline industry. Let's turn our attention to crypto. As I was saying, flying higher. Stocks related to the digital currency continuing to rally. Bitcoin topped $65,000 for the first time since 2021. Katie Greifield is side by side with me. So it's Coinbase flying higher.
Yeah, big time. You take a look at Bitcoin, of course, today up 4%. Like you said, it's above that $65,000 mark. And as you would expect, that's really boosting stocks across the sector. You take a look at Coinbase, like you mentioned, that of course is a big cryptocurrency exchange. Shares currently up 4.5%, actually outpacing Bitcoin, as are some of the other names on this list. MicroStrategy, of course, owns about $10 billion worth of Bitcoin. Clearly, they're profiting today. The miners not doing as well at the moment. You have some of the big Bitcoin miners there, Marathon Digital and Riot Platforms, of course, up 1 to 2%. Of course, these are some stocks that have been looking at some massive year-to-date gains, so makes sense that maybe they're seeing a little bit of pullback, not quite a pullback, but underperformance here. But this all ties back to Bitcoin. Like you said, it's above $65,000 per coin, getting very, very close to its all-time high, just below $69,000 a coin. That was hit in November 2021. And if you think back, that was a very specific, a very euphoric time in markets, and we're seeing a little bit of a repeat right now. That is great news for Bitcoin, and like you can see on this screen, it's great news for those crypto stocks as well.
Absolutely flying higher. Katie, thank you very much. Turn to tech. Apple, as I say, getting hit with a $2 billion antitrust fine from the EU. What's it over? Abusive App Store practices. And indeed, Ed Ludlow joins me now. It's amazing what the EU have said, isn't it? A decade of abuse by Apple. And they've come in hard with a $2 billion fine.
Yeah, $2 billion, 1.8 billion euros. It's actually the first antitrust fine that the EU has ever issued to Apple. And so it's notable for that fact, but also notable because the expectation is that it would not be as big as this. And essentially, what Apple is also, the EU is also ordering Apple to do is to stop telling other music streamers or preventing them from instructing their own users that they might get a better deal outside of the Apple ecosystem. What the EU or the Commission is presenting to Apple is that because of the policies on their platform, consumers were not aware of a better deal somewhere else and therefore probably spent more money on a streaming service than they had to. Apple, of course, is going to appeal this decision, and they argue the opposite, that there is no evidence, as far as Apple can tell, of any anti-competitive behavior or that the consumer loses out. And, you know, in a relatively pointed statement, they talk about, ironically, in the name of competition, today's decision just cements the dominant position of a successful European company. They don't name that company, but of course, it's in reference to Spotify. Spotify brought the original complaint that led to the investigation that led to today's fine. So I think we've braced now for a long legal battle between Apple and the European Commission on this. The stock is down 1.8%. I'm also showing NVIDIA on the screen, man. It's up 3%, building on the 4% gain Friday, continuing to push fresh record highs. But Notable, it's now leapfrogged Saudi Aramco to be the world's third most valuable company on a dollar market cap basis. You know, we know the story around NVIDIA and the AI infrastructure build out that's happening. When I posted this on social media earlier, a lot of people said, how much further would Apple have to drop for NVIDIA to go into the number 2 spot? The answer, about $700 billion worth of market cap. A lot going on in my world.
Yeah, well, we're seeing a reshaping of what, that Mag 7 to perhaps the famous 5, but it looks as if Europe is digging in, isn't it? Marguerite Vestager, she is holding nothing back in her battle against Apple. Ed, see you later. Now, Bank of America's Jared Woodard is remaining cautious on the road ahead. This is what he writes. Investors love expensive stocks, Fed-dependent bonds, and it's an odd time for a blind date, one that may come to naught if inflation reaccelerates. He joins us now. Jared, I love your humor in this. We love expensive stocks, but of course we love expensive stocks predicated on the view that earnings can continue to grow. So what's not to love if the earnings road ahead of me remains strong?
It's glad to be with you, Matt. It's a great question because as we've just seen from the last round of earnings results, there are quite a few positive surprises. And my colleagues across Bank of America have noted the strength, especially in some of the largest names in the S&P 500. When you have accelerating earnings, it covers many sins. And that's exactly what you've seen in the index this year. It's why in a year that was supposed to be a year of the bond, a year in which deflation-friendly assets would rally as prices cooled off and the Fed cut rates and so on. Instead, we've seen a very different story to start 2024.
So is the year of the bond off the books? I mean, I've got various people now talking about 4.5% no rate cuts. Is the year of the bond dead?
Well, this was, as I say, this was supposed to be their year when you had 4% yield or higher. We were at 5% last year on 10-year Treasury. Many Fed cuts coming any day now, and investors got ahead of themselves, I think, hoping for a calendar year in which deflation-friendly assets would win. Instead, what have you seen? In fixed income, the big winners have been things like senior loans, floating rates, preferreds. Treasuries, TLT ETF, which we cover, is down more than 4% this year. It hasn't worked out at all, and I think that's all down to the persistence and the stickiness of the most difficult to move parts of inflation in the U.S. economy, namely services.
And this is where you drill in. You talk about supercore inflation being stuck at around 3.9% for the past 7 months. Therefore, you must have some sympathy for this building narrative that Powell will double down on giving himself an extension on when he can cut.
Yeah, and my colleagues in economics here at Bank of America have said similar things, that when you think about the risks, maybe the risks are now tilted pretty clearly toward the possibility that sticky inflation, a strong labor market, gives Fed governors plenty of time to make whatever decisions they want to make. There's no sense of urgency. When you look at super core inflation, services minus housing, stuck at almost 4% for the past 7 months, and then in the latest release, actually accelerating 4.3%. That doesn't look like a Fed that has accomplished the battle that it's been fighting over the past year or two. If anything, it gives more reason to think that cuts may be delayed, inflation may become to be more accepted than it was in the past 2 decades. All bad news for fixed income investors who are in the most high quality, most rate sensitive, most inflation sensitive part of the fixed income market, which is unfortunately most fixed income investors. That's why in our prudent yield strategy, we focus on parts of fixed income that can avoid those risks.
And in that prudent yield strategy, you know, I was talking about credit spreads a little bit earlier with my last 2 guests. I was talking about the differential between BBB to BB. I mean, they are so razor thin. So can you just stand up and justify the prudent yield strategy?
Sure, the idea is you've got to take risk somewhere. Most investors, you know, got a wake-up call in 2022, the realization that they were taking much more inflation risk, much more interest rate risk than they might have realized after 2 decades in which those weren't really serious risks that people cared about. We think they are worth caring about in a world that's now much different for the next 20 years than the past 20 years. That means for us, credit risk is much more attractive. That means sectors of the fixed income market, like fallen angel corporate bonds, emerging market debt, floating rate loans, even preferreds, convertibles, high yield munis in a taxable account are incredibly attractive. Those are smaller parts of the market, but we think they offer much better value for a long-term investor.
Just contextualize the emerging market bond and equity potential return for me. I'm a US investor. Why would I want? I mean, I presume if I step out, I look at a hedge basis into EM. But what kind of return can I get on equity and bond in EM?
Emerging market equities, you can get high single-digit returns fairly easily. In fact, maybe contrary to what we might assume, emerging market debt has outperformed historically emerging market equities on both an absolute and risk-adjusted basis. It's been worthwhile to be in the debt of these countries. I think it's particularly attractive now because so many emerging market countries have improved the quality of their balance sheets, adopted a more sober fiscal position. They also have many of the same growth characteristics that investors 50 years ago loved the United States for so much. Favorable demographics, high growth, improving productivity, adoption of new technology, all the same kinds of things that you look for in emerging market countries. We typically look at China as a separate investment decision, but the rest of EM has a lot of those strong long-term features with much better balance sheets today to support a debt burden.
Jared, great context there on the EM trade. My guest this morning on All Things Markets. Coming up on the show, bad news for Biden in the polls as we head into Super Tuesday.
I think Biden's people will do what they did in 2020, which is to get out the vote and not take any of those votes for granted.
Never take the voter for granted. The details to come on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I think Biden's people will do what they did in 2020, which is to get out the vote and not take any of those votes for granted, number one. But no, I don't agree that it's time for panic. Trump's weakness really comes down to, his base is still there, but his base is by no means everything. What he really needs is he needs a party unifier, which he's not going to get, and independence, which he's also not going to get. So there's very much a path still here for the president if he wants to take it and again, not take any of those votes for granted.
A Biden-Trump rematch looking all but certain as we head into Super Tuesday. It's less than 24 hours. It is the single biggest primary day of the year, with voters in 16 states hitting the polls. GOP candidate Nikki Haley picking up her first win in Washington, D.C. over the weekend, but still trails the former President Donald Trump by a wide margin. Anne-Marie Hordourn joins me now to discuss more. So what do you think Haley wants to achieve out of this Super Tuesday, Anne-Marie? What would success look like for her relative to the presumptive run by Trump?
Well, she said she always said she's going to stick it out through Super Tuesday. She's still bringing in, some big donors have decided to park their funds, even though they personally do endorse her and would have loved to have seen a Haley ticket. She is still bringing in some of these funds. She can use it in the future. She hasn't said what she's going to do past Super Tuesday. What is interesting to look at for Super Tuesday, because it's not so super, it's very anticlimactic, given the sense that we know that it's going to be Trump. He's on course to dominate and win it. What will be interesting to see is how much of margins he's winning. Some of these primaries are open, some of them are closed. In the open primaries, we did see Haley do well. A lot of independents, even maybe some individuals who would normally say they vote Democratic, came in and supported her in an open primary. In a closed primary, you have to be a Republican voter, and that's what your ID is, then potentially does she do worse? So it'll be just to see interesting on how steep is the climb for former President Trump in a general election when you look at some of the data we're going to get out of Super Tuesday.
Post Super Tuesday, do you think it defines even more clearly where Trump will battleground this election, based on the assumption that he is the candidate?
In terms of the electorate, yes. Where does he need to go after? How much more work does he need to do with independence, with women? But in terms of states, we know the battleground states.
That would be the 7 swings.
These are the 7 swing states, and this is where, the election will be won or lost for Biden or for Trump.
State of the Union. I mean, maybe we can get a little bit more enthusiastic about that. But can you qualify for me the kite flying around tax rises that Biden may float into the spectrum?
Well, you're going to hear a lot from the president. Some of this is going to be aspirational as well, what he would like to see. But this is really his pitch to the American people for another 4 years. And when you think about tax rises, I sometimes laugh because when the Democrats had control of the executive branch, the House, and the Senate, they weren't even able to close the carried interest loophole and left a lot of the Trump-era tax cuts in place. But a lot of this is also going to be the president trying to speak to different constituents within the Democratic Party.
Do you think it still holds as much sway as it formerly did, or in this Instagram communication process? They're trying to find their communication mode, and it's not in the State of the Union, Anne-Marie, in the speech.
Well, the State of the Union is going to be important, I think, for more how the president delivers the message more than what the message is. And that is because over the weekend, poll after poll, the New York Times led in their New York Times Siena poll over the weekend about Biden's age. 61% say he is, quote, just too old to be president. So how he delivers this, if he comes out looking energetic, enthusiastic, that is going to mean more than a lot of voters than potentially the details of some of his plans he has for the next 4 years if he was to remain in the White House.
Okay, you won't get much sleep this week. That's Anne-Marie Hordourn on all things political. You can see her every day on Surveillance, 6 a.m. through 9 a.m. with the Surveillance team. Coming up, sector price action. Let's get across to Abigail Doolittle. How's it forming up, Abby?
Well, we're looking at a small decline for the S&P 500. It's somewhat broad-based from a sector standpoint. The worst sector on the day, communication services, really being dragged on by Alphabet. We also have real estate, energy, consumer discretionary, and others down by 0.4% or more. A few of the sectors to the upside, not up more than 0.5%, but materials, industrials, financials, and tech. Let's dig in just a little bit more because there's two big names, of course, that are dragging on the S&P 500 this morning. That is Tesla on those lower shipments out of China, the lowest in about a year. That stock down about 4.2%. And then Apple, well below its 200-day moving average, really diverging from the S&P 500 by nearly 20% over the last few months. Today down 2.5%. We have Evercore ISI joining Goldman Sachs on the idea that it's off the conviction list. But there you can see the worst sector on the day, communication services, and that NYSE FANG index down about 0.6%, being dragged on by some of those mega cap tech names. Manus.
Abby, thank you very much. Coming up, the market moving events that you'll be watching, setting the agenda for the day and the week, right here on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Reluctance to rally. That is the narrative on the Nasdaq and the S&P 500 this morning. Apple is down as Europe shows its real teeth on regulation. $2 billion fine. It will be appealed by Apple, but that is the drag this morning across some of the technology sector. Let me set you up with your trading diary. This is what you need to watch for the week. Philly Fed President Patrick Harker speaks a little bit later this afternoon. Tomorrow, all eyes are, of course, on Super Tuesday. How will Haley come off there against the former President of the United States, Donald Trump? Chair Powell testifies on Capitol Hill on Wednesday and Thursday. Thursday night, it is President Biden delivering State of the Union address. And it will come down, as Anne-Marie just said, perhaps to more style over substance. Friday, it is the jobs report. What are the wages in the United States of America? And what is the state of jobs? Any sign of a slowdown? The narrative across programming this morning on Bloomberg is a no-landing scenario, which has implications on the rates market. That was countdown to the open. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges.
Fed was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning. Broadcasting live from the campus of New Jersey Institute of Technology, NJIT. We are in Newark, New Jersey. Fantastic place to be here. A lot of smart technology people. We're going to be talking artificial intelligence today. That's a thing, I think, Alex.
It's a thing. It's here to stay, and different applications will be huge.
It's moving the markets. It's been moving the markets really for the last year or so, but we're going to get to the science of it here at NJIT. Coming up, we're going to talk to George Ferguson, just to figure out what the heck's going on there with the airline business. JetBlue abandons troubled $3.8 billion offer for Spirit Airlines, so we're going to get the update there. We're going to check in with Michael Johnson. He's the president of New Jersey Innovation Institute. He's the good folks helping corporations interface with the smart people at NJIT, so we're going to check in with him. Beth Simone Novak, Chief AI Strategist, the state of New Jersey, on implementing New Jersey Governor Phil Murphy's vision for having New Jersey lead the nation in advancement in AI. I'm all in for that. There's some smart people here. There would not be a Silicon Valley if it weren't for New Jersey and the Institute for Advanced Study down there in Princeton and New Brunswick. That's my call there. So anyway, lots of smart people we're going to check in with here. We're talking AI and another smart person. We'll kick it off with Mr. John Tucker, who's got a Bloomberg Business Flash. John.
All right. Thanks a lot, Paul. Let me start with this headline. It's not business related, but the Supreme Court just ruling that Donald Trump can appear on the presidential ballots. I know you're going to break that down in a few minutes with our legal expert, June Grasso. As for markets, after Friday's record close for the S&P 500, the NASDAQ and the NASDAQ 100, a rally taking a bit of a breather right now. The major averages little change at this point, but you look at chipmaker NVIDIA adding right now more than 2%. It's one of the best performing stocks in the S&P 500. Worst performing stock, that belongs to Warner Brothers Discovery. Well, since the end of October, the lows there, the S&P 500 has rallied 25% through Friday's close. In that same time period, the NASDAQ 100 up 30%. And Dan Morris at BNP Paribas says the AI-driven rally does have further to run.
If you look at the GDP revision that we just got back for the U.S., if you dig into the detail, one thing you see is a huge increase in investment in software. So, that's underpinning this rise in earnings expectations. It is still all about AI, and I think it's pretty premature to say that that's running the course.
And 489 companies in the S&P 500 have reported earnings so far this season. Of those, earnings growth on average just around 8%. And 76% of those companies have delivered positive earnings surprises. The S&P 500 4 points lower right now, 5132 on the index. Dow Jones Industrial Average down 86 points, and the NASDAQ 100 34 points lower. That's down about 0.2%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. We are being brought to you by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. Let's head back to the campus of the New Jersey Institute of Technology. Alex and Paul.
All right, JT, thank you so much. We appreciate it. Alex Steele, Paul Sweeney. We are broadcasting live from the campus of NJIT, New Jersey Institute of Technology in Newark, New Jersey. Alex, you made it here from Brooklyn.
I did.
Via Manhattan to Newark.
Yeah.
Boom.
Can I say I've never been to Newark except for the airport?
Okay.
This is my first time spending some real time in there.
Great town.
Okay.
Ironbound, great food. The Devils, I go to the Devils games all the time. Good stuff there. Used to have the Newark Bears. That was kind of funny. You could bring the kids there back in the day. Good stuff happening here. A lot of stuff going on out there in the marketplace. Let's check in with Nora Melinda. She covers the equity markets for Bloomberg News. Hey, Nora, what are you looking at this morning?
Well, it's Merger Monday, and we're really seeing some things on the opposite end. So we had JetBlue and Spirit and mutually agreed to terminate that $3.8 billion merger agreement that we were looking at and was highly in focus as of recent. And the CEO of JetBlue actually said that, quote, the probability of getting the green light to move forward with the merger anytime soon is extremely low. So we've got some JetBlue shares pairing, but earlier up as much as 5.1%, and Spirit shares plunging as much as 16% on the news.
It's like the anti-merger Monday. That's pretty much what that is. But Macy's, maybe another merger situation, potentially. What's going on there?
Right. So looking at Macy's, this company, of course, is a lot smaller than it used to be. Of course, we know that the company just recently said that it's going to be closing about 150 of its stores here in the U.S. But we've got some investors raising their bid by 14% after their previous proposal was shrugged off. This is Ark House Management and Brigade Capital Management boosting that offer by 14%. They're now offering $24 per share, up from about $21 a share previously.
Super micro. What is this thing again?
It's a Bitcoin thing.
This is, of course, back in the AI space.
It's an AI thing, maybe.
Yes. Right on the nose.
Okay.
These guys in my audience. Super micro. I mean, the stock's just ripping.
Exactly. I mean, the stock has actually risen about 219% as of the last close for the year to date. But today it's up about 21%. That's its highest intraday level on record. It's really interesting here after the company was actually named to the S&P 500 on Friday. It's going to be replacing Whirlpool. And then, of course, we do know that Deckers Outdoor, which is more of a footwear company, was replacing Zion's. But, of course, we know joining the coveted benchmark, the S&P 500, is something that we all love to see here.
It feels very significant. Super micro, Whirlpool, like that dynamic.
Yeah, exactly. Yeah, another stock I don't own. All right, Nora, thanks so much for joining us. Nora Melinda covers the equities for Bloomberg News. All right, news crossing the tape here. The Supreme Court rules that President Trump can appear on presidential ballots. Let's go to June Grasso, our legal analyst at Bloomberg News. June, was this expected? What do you make of this?
Very much expected. I don't think after hearing the oral arguments, anyone thought anything but that the Supreme Court was going to allow Donald Trump to be on the ballot this year. all the justices across the ideological lines found a lot of problems with having a single state make a determination not only for its citizens but also for the rest of the country. So that was the idea. You didn't want different states to do different things. And also, I remember Justice Roberts said that it would end up being very partisan. It would come down to a handful of states, and Democrats then in the future would try to get Republicans off the ballot. Republicans would try to get Democrats off the ballot. And Donald Trump said that this was a beautiful hearing, so we all knew what was going to happen.
How was the split, June?
So the split, there was no split. That's what's important about this decision. One of the important things, it's a unanimous decision, per curiam decision, which means that no one in the court is saying, I wrote this opinion. And what they base it on is that the states don't have the power under the Constitution to enforce Section 3 of the 14th Amendment, which is the section that this was under. And so that's with respect to federal officers, especially the presidency. There were some concurrences. That means they agree with the holding in the case, but they have different reasoning. And there was a joint concurrence by 3 of the liberal justices, and then a concurrence by Justice Amy Coney Barrett. And what they were basically saying is the court should have decided this on a narrower ground. That the idea with the Supreme Court is that you're supposed to decide things on the narrowest ground possible, and particularly the Roberts Court doesn't like making broad assertions unless they have to. So that was the objection, and I haven't had a chance to read it. It's not very long. It's only 20 pages long, but I still haven't had a chance to read it. So that's next.
Because we need to chat with you. Just real quick, June, can you refresh our memory? What's up next legal calendar-wise for the former president?
I believe it's March 25th that his trial in New York on the hush money payments will begin. And that's, assuming that goes off on time, that there are no, possible ways at this point to slow it down. It looks like it is going to go at that time. And then we have all the other criminal cases are just up in the air. There's no schedule for any of those other cases. And with the Supreme Court, and just notice how fast the Supreme Court came down with this decision. It was a month from the time that of the oral arguments, and the oral arguments were scheduled very quickly. On the other hand, in the presidential immunity case, where Donald Trump is claiming that he's immune from prosecution, they have set out a schedule that's much longer than this, and the arguments aren't going to even begin until April. And so one wonders why they couldn't have done that question as fast as this question. One being me, I wonder.
I mean, they can move fast, I guess, is what we learned.
They can move much faster. Think about, Bush v. Gore and, a lot of other decisions. They can move fast if they want to, and that's why I'm not the only one. A lot of people are questioning why they decided to slow it down. I mean, it's faster than normal, because normal is a snail's pace with the Supreme Court. So it's faster than normal, but it's not as fast as it could be, and that's a case that's been briefed twice already up to the D.C. Appellate Court. There's not much else left to say there.
All right. June, thank you so much for joining us, and I feel like we're going to be chatting with you pretty frequently over the next several weeks and months. June Grasso, legal analyst for Bloomberg, and we appreciate getting a few minutes of her time on that news. Again, Alex, it's kind of a unmerger or demerger Monday here, certainly in the airline space. JetBlue abandons troubled $3.8 billion offer for Spirit Airlines. Let's get the details here from George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. George, what happened here?
Well, I guess a lot of things happened, but I think this was widely expected, right? As this whole thing developed, I wondered, if it wasn't sort of Robin, the former CEO, maybe one of his bigger master plans that just wasn't going to come to fruition, just didn't have enough support here, inside the company. I mean, I think, along the way, they ended up in a court case, with a Justice Department that doesn't want to see a lot of mergers take place in the U.S. economy, I think. And it didn't seem like this was going to be insurmountable, but, but they lost. And what I'm hearing from people on the legal side of the world is that it was very unlikely that, that any appeal was going to be, was going to come good things for them either. So I think given the legal problems, given that they have Icon on the board now, looking to try to take some value at JetBlue, I think JetBlue has a lot of better things to do with its time, and so they just ultimately walked away. But again, we expected it.
So, George, what will JetBlue do with its time now? I mean, they still need something, right? They still have to be able to compete with United and Delta and American.
I don't know that the purchase of Spirit was going to get them there. I think it would have made an interesting low-cost carrier that, it would have broadened their horizons to be more of a cover the full U.S. But I think it would have been a lot of really, really painful years as they tried to merge these two companies together, build a common culture at the companies. And so, I don't think they were going to be there for half a decade. So I don't know that matters that much. I think JetBlue could go back to being what JetBlue is, and that is a really good East Coast, Caribbean, largely leisure airline with upscale, in their Mint program. And I think if they ultimately want to be a carrier that has the full U.S. domestic footprint, I think they got to look at, maybe a different partner that would that has more similar culture they could get together with.
Hey, George, the bigger question for me and for, I think, a lot of people in a lot of markets around the U.S. is, what happens to Spirit? These guys, they got a lot of debt coming due. What do they do now?
I feel bad for Spirit. I really do.
Yeah.
Yeah.
No, I do think that's the bigger risk here, and I think that there is a lot of debt coming in 2025. They got to sort that out. I think their operations have not been performing well, and so. And I think they lost sight of sort of their primary objective at the company, and that was go out there, fly routes, try to make money, and so they got to find a way to reinvigorate their business in a marketplace where it looks like the low cost is probably where the most pressure is right now in the business. Where it looks like that's the part where I think you're seeing some of the demand fall away. I think you're seeing a lot of competition around space. And so Spirit is in a rough place. Again, I think they got to reinvigorate the company, try to find ways to make money in that low end of the business. It's going to be very hard for them.
Yeah. So, how? I mean, you're right. It is going to be hard. So, how would they actually do it?
Well, I mean, unfortunately, you got to play the hand you're dealt here, right? And there's no easy fix. I'd love to tell you that this is exactly what Spirit has to do. But what we're seeing right now in the airline business is at the low end of the spectrum. Let's say the low end of the consumer spectrum. The ultra low cost carriers and some of the low cost folks. They're all flying bigger airplanes. They're all flying to similar places. The revenge travel rebound is kind of over. So people just aren't paying whatever it takes to fly to Disney anymore, and it's hard to diversify their routes away from some of the bigger leisure markets because, like I said, they're flying larger airplanes. So, I don't know. I mean, I think near term they've got to do some balance sheet work. So maybe they got to get together with creditors and say, hey, the business probably isn't going to throw off great earnings in the next couple of years, but we got to survive while we wait for the market to improve. We wait for capacity to come out, help us restructure some of this debt so there could be a going concern, and then, like I said, this is probably not going to be a great year for them either way, but they got to find a way to survive as they wait for the market to absorb the capacity and for pricing to
I
get
want a
better.
bank that
Of
shows
course,
me
I
what
will
I
say,
spend
one of the
instantly.
things that
With Monzo, give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
What is that?
This is a conference that takes place. They have one in the U.S., one in Asia, one in Europe every year. And all of the folks that trade airplanes and trade jet engines, lessors, different financiers, they get together for about 3 days of deal making. Everybody, got an airplane they want to sell, got an airplane they want to buy. And so all the noise around them is going to be those folks trying to cut deals for 3 days.
Wheeling and dealing.
I'm from the UK and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry, meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
The Bloomberg News. With this Bloomberg Business Flash, we have for Friday's record close for the S&P 500, the NASDAQ, and the NASDAQ 100. Stocks right now, little change. In the S&P 500, you have 7 of the 11 major industry groups. They are lower right now. Communication services, that's the biggest drag of the index, and that's where you're going to find shares of Google parent Alphabet. They are down about 2.5%. Then shares of NVIDIA, they continue to power higher. Right now, NVIDIA shares up 3.1% in this morning's trading. Apple was hit with a $2 billion penalty for the European Union over an investigation into allegations it shut out music streaming rivals, including Spotify technology on its platforms. As